anticipating a 12% drop year over year in the fourth quarter. It's hard to imagine fourth quarter is going to be worse than third quarter, especially considering in the early stages of third quarter, we were just starting to reopen as an economy. So it does seem that the S&P 500 has a relatively clear path to victory. That earnings growth is going to rotate into sectors that are most beaten down in 2020. It's really tough to say that you're not going to get earnings growth off of a double-digit contraction in the first half of this year. We're likely to see it, and we're likely to see it in some of the most beaten down names. And I think that the market started pricing for this in early September. So the market is telling you you're going to get an earnings recovery. Now the question is, can that earnings recovery be even faster than the market or the analysts anticipate? And we think that it's highly likely that we see that.
Gina, good morning from London. But does that mean that we're going to lose that support from the fiscal program, or get a smaller than expected fiscal stimulus in the US, and that we're going to get policymakers at least trying to think about normalizing? So what does that do to the markets?
I think the policymakers that you really want to watch, frankly, are the Fed. We may get a $2 trillion fiscal package. Nobody really knows. I think it's really difficult to handicap that at this point in time. It's somewhat dependent upon assumptions that we do revert to a slower pace of economic growth in the fourth quarter, that we do see shutdowns emerge in the winter months. It's difficult to say whether we're going to see that. Right now, it looks like even quasi-shutdowns in the U.S. today are going to look very different than the March shutdowns. Naturally, the fiscal package is likely to be significantly smaller. I do think if we do have shutdowns and a contraction in economic growth, policymakers will be quicker than most of us anticipate to respond to that. But we haven't had those shutdowns yet. So I think we want to sort of hedge our bets on that. I think the bigger picture to watch is really the Fed. And as you move into the second half of 2021, anticipating 2022, which will be a much more normalized economy, does the Fed have to start changing their messaging? Because they've been very consistently messaging extraordinary dovishness, consistently very, very low rates. The yield curve, however, is starting to steepen a little bit. Will it steepen even more significantly into later 2021? So I think the policymakers to watch really are the Fed, what's happening with monetary policy, what's the impact of that monetary policy. Even a modest shift in language can have a pretty significant impact on the S&P 500 multiple in particular. But that's really not a worry for us until the second half of 2021. In the meantime, you do have a lot of choppiness with respect to economic growth, and you can anticipate a choppy environment. But I think the market is frankly going to look through that and say, okay, policymakers will respond if we do have a need. We will see something occur in terms of economic improvement into the middle of 2021. Right. That's what's going to drive the market in the near term.
Yeah, if we have a vaccine breakthrough, and we kind of had a hint at that this week, but we don't really know the timeline. But if we have it, how much of a revival in economic growth can we see? Can it be quicker than what we're expecting?
Yeah, it absolutely can be quicker. I mean, I think that's part of what happened on Monday is the market was surprised by the idea that not only is a vaccine timeline still in place, but we can be more confident in that timeline going forward. The more companies that continue to come out and give us those confident results, the more confident the market can be. Sentiment starts to shift in a more positive tone. I mean, I think a lot of this is really about where we've been. We've been in an environment of an extraordinary uncertainty, extraordinary economic uncertainty. We certainly have very little confidence that we are going to move into a much stronger recovery. A vaccine solidifies the recovery that analysts are anticipating and probably amps it up and maybe even pulls it forward. And I do think that that's an important sort of contingency or an important factor to watch for where stocks actually go is none of us are really anticipating a huge boost in growth. If you get a vaccine, if you start to see real economic improvement, that's certainly not in the numbers for 2021.
Thank you so much, Gina Martin-Adams there, Bloomberg Intelligence Chief Equity Strategist. Now, coming up, we continue tracking COVID-19. Jason Farley, Johns Hopkins University nursing professor, joins us next. This is Bloomberg.
did better than expected, not only in terms of job creation, but also a sharp fall in the unemployment rate consistent with higher labor force participation. That's really good news.
Overall, the gain was solid, but even while this is a very robust pace of job gains, it's a lot slower than it has been in the summer months.
Great that we saw the job gains we did, but they still are diminished from what they were, of course, back in April and May. And the scarring, the sort of wounds that were created by COVID are beginning to fester.
I would caution people to look at the top line number because I don't think it tells the entire story. Employment relative to population is still well below where we were pre-crisis, and that's because I think that we're going to have some lasting damage.
Depending on what you look at, jobs creation or the unemployment rate, you have different views as to whether the improvement in the labor force is keeping up or slowing down.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
We're well on our way to well over 200,000 cases a day. Our healthcare system is already overwhelmed in many locations in the country, and that is only going to continue to increase as these new numbers add up. And they are, in a sense, you might say, already in the pipeline if we don't have some immediate action for people to distance themselves from sharing air with other people, which I don't see happening. So we're going to have a serious crisis, much more than we've had already, just within the next, weeks to months.
Biden COVID task force member Michael Osterholm there speaking with Bloomberg's David Weston. Well, as we continue to track the virus, Bloomberg has developed this unique partnership with the leading authority on COVID-19, Johns Hopkins, at the forefront of the international response, and we try and bring you insight from experts every day on, of course, infectious disease and emergency preparedness. Today, we're joined by Jason Farley, Johns Hopkins nursing professor. Jason, thank you so much for joining us. What are you actually expecting from the Biden task force? Could we look at a national lockdown, which would be unprecedented in the U.S., basically being some kind of, circuit breaker to stop the number of cases from rising?
Well, good morning. So right now, when you look at the task force and signals we're getting is that, and look at the names on this list, we know that an evidence-based and data-based approach will be taken. This is a fantastic group of people, everything from, Eric Gooseby, Michael Osterholm, as you just mentioned, Lou Borio. All these names are fantastic, very informed infectious disease experts. So I would say kudos to the Biden administration for these names and others. From what I know about many of these people on this list, and I do know many of them, is that they will take a very evidence-based structure. So it may mean that based on numbers of counts right now, we've now reached 10 million. In the last 10 days, we've seen a 1 million additional cases of COVID-19 just in 10 days, so that the epidemic is accelerating. So their decision-making is really going to be based on what the epidemiology is showing them, and that may mean lockdowns in certain areas. Whether or not that's national or local is to be determined. I would say one more thing. It's striking to me about the task force. There's one glaring absence in this task force. There is no nurse voice on this task force. And importantly, the reason that's important is oftentimes, the injection, in the hand of the individual, the person convincing the patient to get that vaccine is most often the nurse. And really having an idea and a voice on this task force about vaccine hesitancy, particularly the low numbers of vaccine acceptability we're seeing in the population, will be critical. They need a nurse scientist and nursing voices on this task force as well.
But Jason, how do you rebuild that trust then? As you know, you're an expert in nursing. How do you rebuild that trust so that once we have the formula, once we have the shot to give to people, people think it's safe? Is it from the regulators? Do we need to hear from scientists? Who will convince the Americans that this is the right thing to do?
Right. Well, we definitely need trusted voices and receiving the vaccine of whatever form. We need them to be consistent in their messaging, and I think the Biden administration will provide us some consistency in messaging. And we need the task force and its recommendations to be really evidence-based and communicate that in its simplest terms to the American people. So the communication piece is vital, and it must be consistent communication. And then we need to show real leadership amongst people on this task force, the president, the vice president, all moving forward and taking an available vaccine, being willing to stand up and be among the first of the American people to do so, our first responders, all very important signs that this vaccine is safe and effective.
Jason, as the number of infections are rising, is it the number of hospitalizations also rising, or are we seeing, a less deadly virus this time around?
No, the number of hospitalizations are rising across the country. We are clearly seeing actually mortality in certain spots across the country rise as well. Again, it's about an access issue. So capacity at the hospital level, capacity of staff, availability of the treatments that we know will help reduce mortality are not equally distributed across the country at this point. So that's going to be a critical driver of excess mortality.
Jason, thank you so much. Jason Farley there of Johns Hopkins. And be sure to check out VRUS Go on the Bloomberg for the latest information. You can also tune in every day for our exclusive conversation with Johns Hopkins experts. Coming up, more Bloomberg surveillance.
need to know we're going to get stimulus, and not just Band-Aid stimulus, but real infrastructure spending.
I think the vaccine, in a way, should be seen as a global fiscal stimulus.
The vaccine is really the game changer here to bring us back to normalcy.
It will take time for the vaccine to be deployed, and in the meantime, and we still have many hurdles.
Everything is going to be lower and flatter for longer.
There's just a lot of cash in the sidelines that needs to be put to work.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
From New York and London for our audience worldwide, good morning, good morning. This is Bloomberg Surveillance live on Bloomberg TV and radio. Alongside Tom Keene and Lisa Abramowitz, I'm Jonathan Farrow. Thursday morning, equities lower on the S&P, higher on the NASDAQ. Tom Keene, restrictions from New Jersey, Utah, Massachusetts, and now New York joining in as well.
John, there's so many ways to start our simulcast, and this is without question the most important issue. I really can't say enough, folks, that the blur of information we're getting, the news, the effect on the markets, the effect on the nation's politics. You know what, John? It doesn't matter. The pandemic statistics, the cases, the hospitalizations, and yes, rising death rates, it's front and center.
I couldn't agree more. And the conversation, Tom, is so familiar to everyone sitting here in London, in Europe, watching this play out.
Yeah.
You start at 10 p.m., a curfew. You start to limit in-restaurant dining, and then what? And it's the then what that I think is of concern for a lot of people this morning.
I'm going to do this on radio right now. I'm going to use the hands up like we do on radio. John, that's proven so effective on radio worldwide. J. Byrne Murdoch at the FT. Think of it like there's like 3 hockey pucks of deaths in Europe. It's only 1 hockey puck in the United States, but, you know, thickness. But I'll tell you, John, Europe is way out front in this, and I'm frightened by the idea we will begin to see the deaths expand in Europe. The other thing I'm frightened by, John, is Lisa takes a day off, and the rumor has it she left a bear, and I think she's returned a bull.
Let's see how long this one lasts with Lisa Abramowitz. It's 7:02 in New York. I reckon we can get to about 7:05 before the bear kicks back in.
I'm revived. Sleep is a good thing. I will just tell you that. And I heard, by the way, with all these lovely messages that I cashed out of my triple leveraged airline stocks, bought an apartment in 15 Central Park West, and also was binge watching Alan Partridge. So thank you both, John and Tom, for all of the illuminating information about what I was doing yesterday. I will say today, very key to see whether some of the data that you're talking about, whether some of the virus counts is bleeding into the data. I know that, John, you are going to say this is me already becoming bearish, but 8:30 a.m. we are going to be getting U.S. initial jobless claims, and you're going to continue to see them flattening out. That is the expectation, that basically you might see a little bit of improvement over last week, but Bloomberg Economics expects still 730,000 additional U.S. initial jobless claims as we see this increase in virus counts. Also, we're going to be expecting a muted inflation print with that CPI data. 11 a.m., another high-frequency data point, the U.S. crude oil inventories. This comes as the IEA ratchet backs their expectation of demand for oil. We are looking to see whether you see a commensurate build in inventories or a decline that is less than people expect. And at 1 p.m., I know, Tom, this is your favorite, so I did this for you. U.S. is planning to sell a record $27 billion of 30-year bonds. This comes as yields just come off of the highest levels since March. Well, the key issue, yes, Tom, what?
No, continue. I don't mean to interrupt.
No, I mean, I'm just curious to see how much demand, how much dealers are going to take down versus independent buyers who are going to lock in these yields because they do see slower growth and they don't think that a vaccine is going to provide the panacea for growth going forward.
Okay, John, fold that back into what we heard from Lagarde yesterday, because over here we've got almost normal auction markets. Does Lagarde have normal, full faith and credit auction markets in Europe?
Well, define normal. Normal in the sense that if you buy debt in Europe and you want to sell it later, you could probably sell it to the ECB. You could do the same thing in the United States as well. I don't think there's anything normal about bond markets worldwide at the moment, Tom. And you can see that across Europe and in the US too. I want to touch on a price action.
Please.
Tom Keene, when he cuts into people and he says, I don't mean to interrupt. What else do you mean if they're mid-sentence and you say something?
I don't know. I'm
and you stop
stressed
them
out.
from talking?
You know, I'm starting to think about Thanksgiving. I'm trying to focus here.
I recommend a day off.
Focus. In the FX market, euro dollar 118.10. We'll ask the question through the next couple of hours. This really interesting inverse correlation between cyclical appetite and the performance of the euro. Not what you might expect. Euro dollar is positive. S&P 500 futures negative. NASDAQ futures positive, up 1/3%. Much more to come on that. And Tom, as Lisa mentioned, at the long end of the curve, the bid is back. Yields come in 3 basis points. So we got to a new upper end of the range on a 10-year Treasury and then just pulled back a little bit, down 3 basis points to 0.94%. Interesting whether we can really get through 1%, Tom, and ask the question, how much life, oxygen, is north of that level?
Well, yeah, we'll go with the 1% mark, but what I'd really go with, John, is yesterday, granted, bond market closed, and today you're getting a reversion back to where the tech NASDAQ sort of leads the way up and down. You're getting back to more normal equity dynamics off the election vaccine oddity of a few days ago.
It is very defensive this morning. Let's bring in David Kelly, shall we? JP Morgan Asset Management Chief Global Strategist. So, David, help us understand two things. Near-term outlook, darkening. Long-term outlook, medium-term outlook, getting brighter. How do you navigate those two things at the moment?
Well, one of the advantages of being a bear is you can always hibernate. I think a lot of people would like to hibernate through the next few months because it is going to be pretty rough. You can look at those case counts. You know how this is going to play out. It's going to be difficult for the economy. It's going to be very difficult for people's lives. We think that growth in the U.S. is going to slow down to about 3% growth, if that, over the next quarter or two. But beyond that, the vaccine news is good news, and we're past, I think, the election uncertainty in reality, whatever may be going on in Washington right now. And I do think the vaccine is going to make a big difference, because the difference between a vaccine that's 60% effective and 90% effective it's a big difference, because it means that eventually we'll be able to squash this thing. So we do think the growth will pick up a lot in the second half of next year as people get back to normal and people start doing all the things they haven't been able to do for a year and a half. So we do see a surge then, but we do have to go through a pretty rough time for the economy and for society between now and then.
David, help us with the application of when strategists shift and go bullish. We saw this from Goldman Sachs. David, you may be familiar with them as a small bank downtown. And also JP Morgan, again, shifting to a more bullish tact as well. How does your world change when a team at JP Morgan gets, quote unquote, more bullish, like Lisa Abramowitz?
Well, we obviously we try and do the research ourselves. We're trying not to be influenced by other teams, but there is a logic to this thing. I mean, if stocks, even long-term bonds are very long-term investments, so you've got to look past the next 6 months. And very often, the best way to make money in the long run is to fade whatever emotion is in the market at the time. So yes, we've got this rising case count, and it's dreadful from many perspectives, but you've just got to look beyond that. And I think the other thing that's very important for world markets in general is, with the new administration, I think you're going to have more certainty on trade. I think that's one of the reasons the dollar is going down. But also a falling dollar is advantageous for a lot of reasons. I think it will help out emerging markets. I think it will help U.S. investors with foreign investments. It should help S&P 500 earnings. And then a divided government means you don't necessarily get an increase in corporate taxes. So put all this together, there are plenty of reasons to be optimistic once you can get past this pandemic.
David, you said fade the emotion in markets, a fascinating turn of phrase at a time when the motion that we have seen, at least so far this week until today, has been borderline euphoric. So are you fading the hope that they are having next year, or do you think that we still have some pessimism baked into markets where they are?
No, I don't mean that. I mean fade the emotion that's bubbling up in society and will bubble up over the next week ahead. These case counts are rising very, very rapidly. So if it keeps on the same trajectory, within a week people are going to be talking about nothing but the misery that COVID is inflicting upon us, and talking about shutdowns and lockdowns and businesses in trouble. So the emotion, I'm not necessarily talking about the emotion of the last week and sort of the weirdness after the election. I'm talking about what's just ahead of us here. I think people should not overplay that. I think they should recognize that there is light at the end of the tunnel, even though the tunnel itself right now is getting darker.
Well, David, it keeps coming back to the same question we've asked repeatedly in the last couple of days about this. How much bad news is this market willing to ignore? Just how much?
Well, the problem is we've got this market which is being supported by these very easy central banks. There is nowhere else to go. There's a lot of liquidity, and that's really what's supporting this market. And I think the market can probably look through a fair amount of that. I mean, until there's something that's going to pull money away from upper income individuals and institutions that can put this money to work. There's money that needs to go to work. Where's it going to go to work? I would say that, longer term, as uncertainty fades, you want to really look at valuations more than momentum. So we've got a lot of momentum in mega cap growth stocks. That's kind of been the continuing trade of 2020. But I think as uncertainty diminishes, as you get back to a more normal economy, and particularly if you get a correction at some stage, then people are going to focus more on valuations. And valuations look a lot better in US value stocks and in EM and developed country international stocks than they do in the S&P 500 overall, and particularly in mega cap growth stocks.
Mega cap growth right now, bid, NASDAQ firmer. David, great to catch up with you. David Kelly there of JP Morgan Asset Management. Thank you. The vaccine story is just one part of the uncertainty. The other part is the increased infections. The third part is what's happening down in Washington. Senator Cotton from Arkansas, Tom, we have time to reach an orderly resolution on the election. That's the approach at the moment, and a lot of people seemingly share that calm, relaxed attitude to what is taking place.
Washington waking up in about an hour and a half, and you really wonder what the news events will be today. I'm focused on the CIA director and her future. John, that's all speculation right now. She did meet with Senator McConnell yesterday. There's any number of themes here as well, but certainly it's a stew of issues that we're looking at within politics, this renewed pandemic, and just trying to keep track of the markets. Look at the China news that we've seen just in the last 2 hours.
With Hong Kong, Tom, the other really interesting thing, a week ago was a Fed decision. 1 week was when we heard from Chairman Powell. How much has happened in that 1 week? We've had vaccine news. Yes. We've had increasing COVID cases. We've got a president-elect, effectively a contested election. He speaks a little bit later with Christine Lagarde. Tom, that's where the emphasis still is. We thought it would shift from monetary policy to fiscal. This is still a monetary policy story.
It is definitely much. I thought David Kelly was great here, how he said his division is not influenced so much at JP Morgan by other divisions. And John, it's a lot like you and me, how you and I are not influenced by Lisa's new bullishness. I mean,
not at all.
You gotta be careful. We are not influenced by Abramowitz. We're just trying.
Oil barrels. I recommend them at your 15
so
Central Park
happy.
West. Well, it's nice to get some sleep.
I just don't get it.
The bear
she was up in
hibernated.
the Catskills picking out a turkey.
We'll just try and wind her up through the next couple of hours. Alongside Tom Keene, I'm Jonathan Ferro. Great to have Lisa back in a seat. Much more still to come. Heard on Bloomberg Radio, seen on Bloomberg TV. A beautiful city of London here. I understand a great New York over the last couple of weeks too. This is Bloomberg.
With the First Word News, I'm Rishka Gupta. The state of Georgia will conduct a hand recount of ballots for the presidential race. Joe Biden leads President Trump by a slim margin of about 14,000 votes out of roughly 5 million cast. The Trump campaign has alleged there were widespread voting irregularities, but it's offered no proof. President-elect Joe Biden has named longtime aide Ron Klain to be White House Chief of Staff. Klain played a leading role during the economic and public health crises of the Obama administration. The job is one of the most powerful in Washington. The person is the gatekeeper for the president. And Moderna is now poised to take the spotlight on a coronavirus vaccine. The company says the study has accumulated more than 53 infections. That will allow a preliminary analysis of its effectiveness to begin. Moderna didn't predict how long it could take an independent monitoring committee to analyze the data. Wells Fargo is considering whether to sell another of its businesses. Bloomberg's learned the bank is exploring the sale of a unit offering store-branded credit cards. Wells Fargo also is gauging interest in other businesses, such as asset manager and its student loan portfolio. Global News 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Rishka Gupta. This is Bloomberg.
This is Bloomberg Best, your weekly review of the most important business news, analysis, and interviews from Bloomberg Television around the world.
Ken Burns, welcome to Bloomberg Big Decisions.
We have always been a mixture of things. We are always stronger for that mixture.
Growth is a way to stay competitive, delight more and more consumers.
Welcome to the Best of Bloomberg Technology. I'm Emily Chang.
They've moved the needle by acknowledging that they have to monitor the content.
What is one word of advice you'll take with you?
Learn how to listen. And that is certainly something that has served me well.
Ankiti, where do you go from here? It's a huge market. It's a huge opportunity. I want to go 100x from here.
Our philosophy is to partner where we can and stand apart when we should.
Mercedes-Benz is on a path towards CO2 neutral mobility. So we have flicked the switch there, and really we're going to step by step electrify everything. And what does that mean? Combustion engines get electrified.
We're well on our way to well over 200,000 cases a day. Our healthcare system is already overwhelmed in many locations in the country, and that is only going to continue to increase as these new numbers add up. And they are, in a sense, you might say, already in the pipeline if we don't have some immediate action for people to distance themselves from sharing air with other people, which I don't see happening.
Dr. Michael Osterholm there, the Biden COVID task force member, weighing in on the situation in the United States of America right now, and that situation is worsening. Alongside Tom Keene and Lisa Abramowitz, I'm Jonathan Ferro. Here's the price action this Thursday morning. Good morning to you all. A little bit later today, we'll hear from Chairman Powell, President Lagarde, and Governor Bailey, all on the same panel from an ECB forum that will, of course, be virtual. In the FX market, the euro ahead of that, euro dollar north of 118, up a third of 1%. Bid into the bond market, bit defensive today, down 3 or 4 basis points on a 10-year, just south of 94 basis points. In the last couple of minutes, we roll over on equity futures just a little bit. We're down 0.4% on the S&P, call it a third of 1% lower. And on the NASDAQ, Tom, still positive, but by just a tenth of 1% at the moment.
Just looking for direction. Maybe we'll see that at 8:30 with the CPI report. We just heard from Dr. Osterholm. He is a force at Minnesota in epidemiology. What we're going to try to do right now, and it's difficult with Emily Wilkins, her wonderful coverage of Team Biden out in Wilmington, Delaware in the past week. But right now, maybe focus on the pandemic. Emily Wilkins, right now, 6 months ago, there would be a 4 p.m. Rose Garden press conference. They would be trotted out. The president would say something, Fauci, Birx, etc. We're not there right now. If that's not the case, what is Washington doing today about the pandemic?
So a couple different things. I mean, number one, we can look at what Congress is doing. They have restarted talks about a potential stimulus. This is something that both Pelosi and Mitch McConnell have been asked about, the leaders of the House and the Senate, respectively. However, it does seem like we're running into some of the same roadblocks that we were before the election. Republicans and McConnell want a more streamlined bill. That's something that Democrats and Nancy Pelosi has said that they won't accept. You've also started to hear the Biden campaign start talking much more about their plans for addressing the COVID pandemic. They're going to be putting together a task force on that particular issue and starting to really make some recommendations and be ready to hit the ground running when Biden is sworn into office.
But Emily, I'm just seeing zeitgeist. Wisconsin's having huge trouble with beds. Idaho sends their most sickest to Utah, I assume to Salt Lake. They can't do that anymore because Salt Lake won't take Idaho sick patients. What is the present administration doing this morning about the increase in hospitalizations?
That is a great question, and we're keeping an eye on the Trump administration today to see what, if anything, we're hearing from them. We're talking to them in regards to the disease. It is something we were expecting, this another spike when it came in the winter with flu season, and now we're seeing that play out in the numbers.
This is the issue. Tom, it's November 12th. We can't wait until January 20th for a new government to come in and implement new policies. And it's not just about the White House either, Tom. It's about Congress getting something done. For these states to reintroduce something more restrictive, for them to be able to do that and actually get society to come along, you need something from the fiscal side. And you need it fast.
Emily, if
you do indeed think you need to be more restrictive, Tom, let's be clear about that.
Okay, but fine. Emily, you're in the halls of Congress. Cirilli used to have that beat. He's too fancy now over at the White House. What in the walls of Congress, the halls of Congress, are they doing today about the here and now?
I mean, it's once again, it's back to those stimulus negotiations, back to those discussions. And, you know, as you kind of point out, Tom, because we are seeing this sort of dire need for beds for hospitals, that might wind up putting more pressure on lawmakers to act, because that's what we saw back in March, right? With the first wave coming, everyone saying we need to get things done. People were able to put their bipartisanship aside and actually be able to pass something. So that might wind up putting more pressure on lawmakers to actually get something done. But at this point, we still don't have a number of them back at the House. A lot of them are still working through the election. Some of them are even formally reelected yet. We're still waiting for a number of runoffs at this point.
Emily, when you talk about bipartisanship at a time when you've got Democrats accusing Republicans of staging some sort of back-channel coup, and you've got Republicans saying that the Democrats haven't really won the presidency the way that perhaps the numbers bear out, you got to wonder how much oxygen that sucks out of the room to actually get anything done. I mean, can anything potentially get done given this level of venom right now in Washington, D.C.?
Well, Senate Majority Leader Mitch McConnell said that he does want to get some sort of stimulus passed before the end of the year. And you know what? McConnell knows he's coming back next year. Nancy Pelosi knows she's coming back next year. The lawmakers that we have in Washington will at least be there until January. And I think maybe now with the election behind us, there is a drive to get something done for the American people. I think the question is just what does that actually look like in terms of money and in terms of funding?
Emily, great to catch up, as always. Enjoy hearing from you. Emily Wilkins there, Bloomberg government reporter. This is what we heard from Governor Cuomo yesterday. He tweeted out the following. New York State is taking action to stop the spread in response to rising COVID numbers. Went on to say any establishment with a state liquor license, including bars and restaurants, must close at 10 p.m. Gyms must also close at 10 p.m. The statewide rules will take effect Friday, 10 p.m. And then, Tom, there are these restrictions around how many people you can have in your home as well. This is where things get really complicated for people and you get society pushing back. On top of that, if you're telling people that they can't stay out after 10 p.m. effectively, you're pushing them indoors. And if they don't stick to that rule of 10, and I have no idea how it gets enforced, Tom, then you've got another issue on your hands.
Well, you got another issue on your hands, but I'm going to go back to the core issue, which is childcare, John, and the idea of virtual and present school systems as well. Mayor de Blasio here in New York, good morning, Bloomberg 1130. Mayor de Blasio is right on top of this literally as we speak, John. You wonder what New York City schools are going to do Thursday and into Friday.
Do you get the sense, Lisa, that Mayor de Blasio and Governor Cuomo are working hand in hand in a decent way going into the back end of this year?
Come on, you know the answer of that, John. They have a historic rivalry, and there is a question of how much is sort of trying to upstage one another and how much is cooperation. Look, I think that they do agree something needs to be done. John, to your point, though, what kind of cohesive message is it if you start talking about 10 p.m. closures? Yes, people start to get messy when they get drunk, but hard to see how that's going to necessarily stave off some of the numbers alone without some stricter measures.
Yeah, and I could just see a similar response to it in the United States and New York right now compared to what we went through here in London several weeks ago, several months ago. Tom, to build on this, though, I don't want to be too New York-centric this morning.
No, we
if you look
wouldn't
at the
want
numbers
that,
of
John.
certain places, El Paso, the numbers out of there are just scary, really worrying.
Yeah. This is what's really important here, John, is the overlay here of income distribution, of poverty, and also of the morbidities that are out there right now. And, you know, it speaks to, you know, obesity, it speaks to age, it speaks to a lot of other social issues. And what is, as we mentioned with Emily Wilkins, John, I just don't understand the rigidities in Washington over the immediate, which to me seems worse than April. Maybe I'm off on that.
In some places, it is, Tom. We can crunch the numbers a little bit later in the programme. Alongside Tom Keane and Lisa Abramovich, I'm Jonathan Ferro. Much more still to come. A little bit later today, you'll be hearing from Chairman Powell, President Lagarde and Governor Bailey in a panel in several hours' time. Up next on this programme, you'll hear from the wonderful Chris Verone, Strategas Research Partners, Head of Technical Analysis. From London and New York this morning, good morning. Futures negative. This is Bloomberg.
Generation's biggest problem.
Climate change is happening.
And the world's most innovative solutions.
Transport, industry, buildings, electricity, all of those things.
Everything you need to know about our changing environment, the politics of global warming.
We can and we will deal with climate change.
In the fight against climate change, Bloomberg Green has you covered.
From New York and London for our audience worldwide, this is Bloomberg Surveillance. Just want to give you a flavour of the price action 1 hour away from the economic data in America. Just a little bit defensive this morning. Equity futures on the S&P 500 down 1/3%. Nasdaq futures slightly positive. Just bringing you the banks in Europe up 15% still on the week. down 2% on the session. Switch up the board and get to the bond market. Treasury's getting interesting. A new upper end of the trading range of the last 6 months. Low end 50 basis points early August. Top end now around about 97, pushing 1%. We pulled back as we reopen after the close yesterday. We are down 4 basis points on a 10-year to 0.9374%. So after Veterans Day, the bond market gets back to work, and it's back to work with a bid. Finish on this. In foreign exchange, I think this is one of the more fascinating things that has happened this week, or rather has not happened this week. Cyclical appetite returned. What happened with the euro? Euro dollar actually traded negative on a return of cyclical appetite. Why? I don't know. Maybe you've got an answer. This morning, risk appetite diminishes a little bit. What happens? The euro picks up. Euro dollar 118.05, up 0.2%. Tom, you and I have talked about this over the last couple of days. I find it absolutely fascinating what is going on with the euro and that inverse correlation between the single currency and risk appetite.
Now, that quick blended trading asset, euro is about 54% of DXY, the core big nation trading index, and 92.93. You can round that up to 93 now. We just have trouble seeing a weaker dollar this morning. Somebody I've wanted to speak to after the festivities in the market of the last number of days is Christopher Verone of Strategas. He knows, and I know, that there are two ways of looking at the dynamics of the market on paper or on Bloomberg computer screen. One is stochastic, which is basically catching the falling knife or rising knife in the dark, and the other is trend-based analysis. Chris Verone and I fervently believe in trend-based analysis. Chris, did we adjust the trend the other day with what appeared to be a massive shift, a massive jump condition? Did the trend shift?
I don't think so. I think as we see with elections time and time again, and as we talked about on this show just a week and a half ago, the trend going in is often the trend coming out. We've been in a bull market. We remain in a bull market. If anything, patterns are just magnified. And, I think what's key here is how that extends or permeates across asset classes. Bond yields were going up for months leading into this. Bond yields have continued going up on the other side. Curve was steepening. It has continued to steepen. Small caps were improving. They've continued to improve. So I think if anything, election day only magnified, or the vaccine news only magnified, the trends that were already in place.
The trends are already in place. Well, Goldman Sachs on a fundamental basis, JP Morgan on a fundamental basis, go Verone to the moon. Do your charts have the same enthusiasm David Kostin has at Goldman Sachs?
Yeah, and they've had for some time. And I think that kind of brings up what we could see as the potential risk actually over the next number of months. That enthusiasm becomes a little bit too pronounced. There's nothing that worries me more in this business than confidence, conviction, and certainty. And there hasn't been much of that for a lot of people across the street over the last number of months. I do think that is returning here, and that is something as analysts we have to be a little bit more on guard about over the next number of weeks, the next number of months. Does sentiment start to run a little too hot? I don't think we're there yet. We watch flows as our barometer of sentiment, but it has to be something on our radar, whether enthusiasm is just getting a little too robust.
That's where I wanted to go, Chris. We listened to the language. Yesterday, it was JP Morgan talking about market nirvana over the last couple of days. Goldman talking about the roaring 20s. That's the language. Walk me through the flows. What do you see in the numbers?
Yeah, we look at a couple things. Number one, I like to look at aggregated flows. I like to look at flows into the SPY. I like to look at flows into Qs, the tech names. I like to look at flows into small caps. And we aggregate them all to give us one reading. When you tend to get numbers up into the 90th, 95th percentile, that's kind of the warning zone that flows are too aggressively, directionally there. Now, I'd say right now we're in about the 70th percentile. So there's still some room to go before the flow data gets too aggressive here, but it's certainly on our radar, I think, over the next number of weeks. People look at the survey data. I don't love the survey data. What people say they're doing with their money is often very different than what people are actually doing with their money. Watch where the money goes. Watch the flow data.
Well, let's talk about where the money went this week. Europe, in a huge way. That catch-up trade really kicked in, Chris. Walk me through your thoughts on that at the moment, whether it was just that, a one-off repricing, a catch-up trade, or something more.
We wrote this week, European lockdowns, question mark. What European lockdowns. You've had cyclicals continuing to outperform in Europe. You have the banks waking up for the first time in several years there. European autos are hands down one of the best and most improving groups anywhere in the world. That cyclical tone is so much different than how the market interpreted the virus and the lockdowns in February and March and April. And I think that's something as market analysts we have to be really respectful of. We can all have our opinions how this shakes out, but at the end of the day, there's only one opinion that matters, and it's the market's opinion. And I think how the market's rewarding cyclicality in Europe is a very, very compelling story.
So you said a lot, Chris. I want to unpack a little bit of this concept of magnifying the trend. And what we're seeing right now is a bull market that wants to be a bull and that is continuing to be so, at least up till today. I'm wondering, when do we know we've already priced in the next cycle? In other words, we've already sufficiently priced in next year's rotation into cyclicals and next year's vaccine and everything getting back to some sort of normalcy?
I think it's early to make that case, and I want to revisit something we said on the show a few weeks ago. We very much are believers in the idea that we just had a multi-year bear market in cyclicality. I think that multi-year bear market in cyclicality is over. And I'm talking about things like small caps and industrials and materials and Aussie dollar and copper. These are all things that peaked not in 2020, but 3 years ago. Late 2017, early 18 is when cyclicality peaked. So I think after a couple good months here of cyclicality working, it is still way too premature to say the good news is now priced in those. I mean, look at small caps as an example. Russell 2000 has been sideways for 3 years. No one's made any money there until this week. So even in our trend work, small versus large has now flipped positive in our trend work. So I think the character of the market is changing, and we're just magnifying a lot of the changes that have been set in motion over the last several months.
I know that Tom is listening and thinking, does this mean it's an entry point? I do want to shift gears, though, a little bit to the bond market. There's a question of how high yields can go before they become a buy. And it seems like, at least based on today's action, which you cannot extrapolate out, they have become a buy at about 95 basis points. Do you see this as significant, or do you think that yields can rise further from here?
I think what's always striking to us is when security prices don't respond to news as one would suspect they would. And I think if you look at the last 2 weeks, what was initially interpreted as an election that would prove to be associated with lower bond yields, that lasted for about an hour on Wednesday. And then you saw bond yields recover back to new highs and have continued to push forward. You had all the virus news, all the lockdown news. It hasn't affected bond yields. So bond yields seem to be kind of in their own world here. Our best guess is they want to gravitate toward 130, 140. That's where they broke down from in 2020. That's where they held in 2016. So I think there's a lot of, call it magnetic forces, pulling up bond yields to that 130, 140 neighborhood. That is ultimately where we think they go over the next 12 months. What's more important is, what type of curve steepener is that giving us? It's given us a bear steepener. We haven't had a bear steepener in years. A bear steepener tends to be accompanied by very different equity market leadership than what we've had over the past number of years.
I want to give you a broad question, Chris, and go narrow with it from your research node. If we have EM enthusiasm, is the proxy to watch ADXY, the Asian currency index ex-Japan, or is there certain pairs that give you more information?
Tom, you said it. I think ADXY is one of the most important charts out there. Listen, at the end of the day, if EM is going to work, we can't be in a situation where there's capital flight from emerging markets. And I think the currency market is the best barometer of that. Currencies weakening in EM implies currency flight. That's been the story there over the last number of years. We think that's changing now. We think that part of the world is attracting capital. Now, remember, the EEM, which is the emerging market ETF, is now about 40% China. So a bet on EM is really a bet on China here. I think if you look at this broader to developed Asia as well, our biggest call in that region has been Japan. I mean, Japan is the 30-year breakout that no one's talking about. This is one of the best charts we can find anywhere, and it gets, I think, comparatively very, very little attention. Own Japan. It hasn't worked for 3 decades. It's starting to work right now.
Well, let's get a little bit knee-deep in that just for a moment then, Chris. We could talk Japan. That's what we can do on a program like this. You mentioned EM. Alibaba, biggest weighting is Alibaba on EM at 8-9%. You want to own emerging markets right now? Do you want to own tech? If you want to own Japan, what do you want to own Chris, when you say things like that, own EM, own Japan, what do you mean?
I think when you look in Japan, what's remarkable is the diversity of the stocks that have worked. Everything from Sony to Japanese machinery to Japanese robotics. Actually, a very, very diverse index. And one of the things when we talk about Japan, most look to the Nikkei 225 as kind of their benchmark. I would encourage viewers, go look at the Nikkei 500. It's the broader version of the Nikkei. It's already above the December 89 highs. So the Nikkei 225 is still 30 or 40% away from the old highs. The Nikkei 500, the broader index, has already broken out. So this move is broad under the surface in Japan. The other thing I would note with respect to Nikkei, largest weight is Toyota. Toyota's been in a range for 5 years. It's on the verge of breaking out of that range. It was in our note this morning, actually, right on the verge of a 5-year breakout. We think global autos, emphasized by Toyota, by that name, is something that you can get paid for here.
Hey, Chris, great to catch up. Great work, as always. Chris Verone there, of Strategic Research Partners. The Nikkei 500 up 8-9% so far in a month of November. And we're only,
John,
12 days into it, Tom?
I loaded the boat on the NKY 500 about 1991. And it just worked like a charm. Yeah. Dollar base.
That just scarred you. That scarred you for the next couple of decades.
Yes.
Thus the cash.
I mean, the walkers over here, and you ask why I'm not retired, is because I loaded the boat NKY 500.
The story finally came out. There was a long once upon a time. There was an entry point, Lisa.
Yes.
It was back in the late 80s, early 90s in Japan for Tom Keene.
Anyone looking for a reason behind the triple leveraged all cash fund only has to look back to 1991. The scars for Tom Keene.
It was amazing.
Alongside Tom Keene and Lisa Bramwitz. Tom, I've got to go. I've got to go. You know I've got to go. You know what time it is.
What do you got to go get ready for the real yield. I understand. Mid-morning with
there's some sequencing.
Mid-morning with
There's some sequencing in the production that I just have to deal with sometimes. Alongside Tom Keene and Lisa Bramwitz, I'm Jonathan Ferro. Herding cats. That is on my resume. Futures negative 13. We're down 1/3%. This is Bloomberg.
With the First Word News, I'm Ritika Gupta. President Trump suffered 2 setbacks as he tried to claim victory in the state of Arizona. The state's Republican Attorney General told Fox Business it was highly unlikely the president would catch up when remaining ballots are counted. He also said he has found no evidence of widespread fraud that the Trump campaign has alleged. And President-elect Joe Biden has stocked his transition team with policy experts, academics, and former Obama administration officials. That's a contrast with the industry-friendly figures that President Trump appointed. Biden's team includes people who favor stronger government regulation than the current administration. Still, liberals are concerned about the number of tech executives Biden has included. And the British economy expanded the most on record in the third quarter. Growth surged 15.5% after falling almost 20% in the second quarter. Still, the recovery is less than any of its G7 peers. Meanwhile, there's been an increase in coronavirus cases, and British output in September was the worst since April. China and 14 Asia-Pacific nations are close to a deal on the world's largest free trade agreement. It could be completed this weekend. The partnership also includes Japan, Australia, and New Zealand. It would be the culmination of Beijing's decade-long quest for great economic integration. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
came in better than expected, not only in terms of job creation, but also a sharp fall in the unemployment rate consistent with higher labor force participation. That's really good news.
Overall, the gain was solid, but even while this is a very robust pace of job gains, it's a lot slower than it has been in the summer months.
Great that we saw the job gains we did, but they still are diminished from what they were, of course, back in April and May. And the scarring, the sort of wounds that were created by COVID are beginning to fester.
I would caution people to look at the top line number because I don't think it tells the entire story. Employment relative to population is still well below where we were pre-crisis, and that's because I think that we're going to have some lasting damage.
Depending on what you look at, jobs creation or the unemployment rate, you have different views as to whether the improvement in the labor force is keeping up or slowing down.
Explore the trends, investments, and competition of the European ETF industry. Join us on Bloomberg ETF IQ Europe.
Their CPG history, their experience, and really how we might be able to combine together to really create this fantastic public company. And so we kind of got into the SPAC thing a little bit before it became such a hot method of going public.
Testing is the only game in town to get people back to some kind of normal in the very near future, because even with the UK getting early access to a vaccine, it'll take a year and a half to vaccinate the entire country. And of course, this is a global issue, not just a UK-based issue, and it's going to take much longer before even the fastest vaccine can really have a massive impact around the world.
That was John Holland-Kaye there, the Heathrow CEO, catching up with Guy Johnson in the last couple of days. A huge issue. Getting that corridor between London and New York functioning again. Testing has got to be a key part of that. From New York and London this morning, good morning. Alongside Tom Keane and Lisa Abramowitz, I'm Jonathan Ferro. Here's the price action. This Thursday, we shape up as follows. Just a little bit more defensive on the S&P 500. -12, down 1/3%. Euro dollar just south of 118. The big names lined up to talk a little bit later. Chair Powell, President Lagarde, Governor Bailey will all be speaking on the same panel. Ahead of that, into the bond market, just a little bit of fuel for treasuries. Yields come down 4 basis points to 0.94%. On the airlines, Tom, American Airlines on Monday popped 15% off the back of the vaccine news. Then it faded Tuesday, down 6%, faded Wednesday, down 2.75%. That's the tug of war right now between the short term, not pretty, the long term, hopeful.
And American Airlines, of course, with that equity offering that was challenged, to say the least. Right now, we note that we take great pride in whom we speak to about this pandemic. We have talked to Steve Riley at Imperial College, Peter Hotez out at Baylor on vaccines and the dynamics. And right now, Albert Koh of Yale University, to say he is a professor of epidemiology, barely describes his focus on the heart of the matter right now, which is transmission dynamics. He is world-class in this, and we're thrilled he could join us this morning. Dr. Koh, are you smarter about the transmission dynamics of this virus than you were in April?
So Tom, thank you very much for the invitation. And with respect with whether we're smarter, I'm not sure if that's the best way to describe it. We learned much more about how this virus transmits, who it transmits, and where it transmits. I think what we're not necessarily smarter is learning the lessons and translating that knowledge or evidence to policy.
Well, okay, into policy, but we have a policy void. Can we wait until January 20th? Or please color for me the urgency of policy right now in the final days of the Trump administration.
Yeah, so Tom, we're at a critical moment right now, and we can't wait until January for effective action. We're on the exponential curve of growth of cases, not only in new places where the virus has spread in the United States, but also old places. For example, here in the northeast of Connecticut, northeast of the country, we were hit hard in the early part of the epidemic, and now we're having a resurgence at this moment.
Doctor, define exponential for us, if you can, with the numbers that you're seeing currently, and whether what you're saying is once you reach that kind of rate of change, that inevitably the only way to handle this is to lock back down again. Is that what you're implying?
So I'll take the first part. And what do we mean by exponential curve? So this is a virus that propagates by person-to-person contact. So if you have one person in it, it transmits to two people. Those two people transmit to four people. Those four people, up to 16 people. And that's what we call the exponential curve, when there's that uncontrolled transmission and people we're undergoing doubling rates. What the response to that is actually to do several things, and we know the evidence, and we've learned this in the last 10 months of this epidemic. One is face masks, what we call barrier reduction or barrier interventions to prevent people from being exposed to the virus. The other is to decrease the social contact rate. Now that doesn't necessarily need lockdown, but when the cat's out of the bag, or when we have a wildfire of this exponential growth, lockdown, as we've seen back in the early stages of the epidemic, is one of the effective interventions.
Dr. Ko, when we talk about what types of interventions are necessary, I feel like we have to revisit how contagious the disease is and the main methods of transmission. There's some questions about whether it's effective to close bars and restaurants at 10 p.m., whether that actually does anything, whether the surface transmission mechanism is a substantial one or not. What do we know so far about the main modes of transmission other than people looking at each other for more than 15 minutes and speaking and singing at each other?
Right. So we know that person-to-person contact is essential, and it drives transmission. I think you can break it down into three parts. One is the transmission through respiratory droplets. And these are larger droplets that travel roughly 6 feet, and really that type of transmission is fueled by close contact, physical contact. The second is through what we call fomites, or a person coughing or sneezing onto a surface. And then the third is the aerosols. These are smaller droplets that travel much further. But what we know now, we don't actually have the exact figures, but the large majority of transmission is actually fueled by the kind of close contact through respiratory droplets within 6 feet. And that's good news in the sense that we know how to address that. It's use of face masks and to maintaining physical distancing in that scenario.
Dr. Ko, Salvador, Brazil is 1,000 miles or so north of Rio. You've had a huge commitment there to their medicine, their microbiology. I say this with great respect and nothing to demean the Brazilian government. Do you trust the statistics out of Brazil, out of South America, and out of Mexico?
Yeah, so I think, the key issue with surveillance and the numbers and getting reliable numbers, and this is an issue here in the United States, is ramp up of testing, being able to test people who are symptomatic with the disease and to test the vulnerable populations in those settings. This is purely a challenge here in the United States, even in our own vulnerable communities. But this is a challenge throughout poorer countries and developing countries, and even richer countries among that group, such as Brazil. Certainly, there are two key issues. One is, which is key, is the government investment in the response. And we've seen the kind of the foibles and the problems that Brazil has had due to political concerns in the last 8 to 10 months. The other is that there are places in Brazil which are doing extensive testing, places like São Paulo, in many of the states, Belo Horizonte, the city of Belo Horizonte. In the city that I work in Salvador, they're doing quite a bit of testing. So numbers are going to change based on where you are within a country. But the numbers actually, I think what's more important than the absolute number is the trends and where they're going to. Mm-hmm. Many of these places are either going up or they're staying the same.
Doctor, appreciate your time this morning. Thanks for being with us. Come back soon, won't you? Dr. Albert Coe there of Yale University. In the equity market, we do roll over just a little bit. We're down by about 19 points on the S&P 500. We are negative 0.5%, Tom. Just a little bit of weakness creeping in.
Yeah, this weakness coming in, and again, it's not that it's uncorrelated, John. It's just been disjoint all morning. I guess the way to put it.
Let me take you to Augusta National. Live coverage and play-by-play of the Masters on Bloomberg Radio in New York, Boston, and San Francisco, Washington, 1 Eastern.
The big concern is climate change. We can see the global warming accelerating at the moment, and the goals that we must hit are so ambitious. It's 1.5 degrees by 2050, being climate neutral in terms of emissions by 2050. That's a huge challenge. We have to reduce emissions by 50%, 2030, 2040 again. It's very, very ambitious, and mobility plays such a crucial role in there. One thing is to do it in developed countries. I think we're going to get there by 2030, but then the rest of the world, and that's just as important. If you look at developing countries, emerging countries, that's where probably the biggest challenge we are going to face, to also deploy EVs there and make mobility greener in those countries. I know it's possible to move mobility forward fast enough to be able to do its part in this fundamental threat that we're facing.
Market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
know we're going to get stimulus, and not just Band-Aid stimulus, but real infrastructure spending.
I think the vaccine, in a way, should be seen as a global fiscal stimulus.
The vaccine is really the game changer here to bring us back to normalcy.
It will take time for the vaccine to be deployed, and in the meantime, and we still have many hurdles.
Everything is going to be lower and flatter for longer.
There's just a lot of cash in the sidelines that needs to be put to work.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Good morning, everyone. Jonathan Farrow, Lisa Abramowitz, and Tom Keene. Thank you for joining us on our simulcast worldwide. Good morning on Bloomberg Radio. Good morning on Bloomberg Television. Too much to talk about. You hear it within those voices that maybe it's the morning after. And John, the vaccine's really not out there. And now we get into a churn of the immediate news.
It's a tug of war between the forward outlook looking better and the near-term outlook looking worse, and a real divergence between the two. And how policymakers navigate the former will allow markets to keep that hope about the latter. That's the story for this market. First half of the week, all about cyclical appetite. Back half of the week, NASDAQ kicks in again. Again this morning, Tom, with the S&P 500 down 0.6%, and NASDAQ futures just about positive on the day. That's the concern, near-term versus medium-term.
Back to that kind of relationship, we're going to roll the data check through here, not just do one single data check, because it's a mess this morning. I just saw a 93 print on dollar, and Lisa, that speaks to the resiliency of dollar. Yeah, we've had a weaker dollar, but we just seem to come back when the uncertainty reigns.
Yeah, and that seems to be the theme that we've seen with all of the bears on the dollar. They have been burned because when there is a risk-off feel, people go to the dollar. Look, I'm watching today, Tom. I'm watching Treasury yields, and it's in part because of the record auctions this week. But I think that what Chris Verone said in the last hour about how they want to bleed higher to that 130, 140 place, there is a question, and right now we're looking at a 93 print on Treasury yields, at basis points that is. There's a question, what does that do? How much does that rearrange equity valuations? How much does that rearrange people's longer-term growth expectations?
And John, I want to go to the real yield. I know you're in pre-production for the real yield tomorrow, and I make a joke of it, folks, but massive negative real yield, that nominal yield less the inflation or disinflation expectations, inflation data in this hour, and then you come down to the real yield. John, we've had a lesser negative real yield. Now what?
Well, the real yield is at the epicenter of a lot of these moves, Tom. It's been the underpinning of why we've had this positive correlation with gold and equities, because tech growth has been tethered to that story as well. And I think in many ways the US dollar too. Remember, the US dollar, the dollar index, DXY, bottomed back end of August 31st. Big tech topped early September. That's been the relationship between foreign exchange, the US dollar, weighted heavily towards the euro, and risk more broadly, growth stocks. And I think that's interesting to see how that develops in the coming months.
It'll be interesting to see. And, of course, the epicenter of the real yield, look for that tomorrow afternoon on a Friday with John working out of London after Mid-Morning Matters with John Farrow. You'll look for that later on this morning. Right now, I got one more question. Lisa, I'm going to go to you. Am I right that in the last number of days, full faith and credit is really separated from high yield and investment grade? Is that a correct statement?
That basically it's gotten more expensive for the U.S. government up until today to borrow money, and it's gotten a lot less expensive for riskier companies to borrow money, which is typically what you'd see in a risk-on environment. Basically, that spread, that extra yield that investors demand is evaporating because they see the perceived risk as dissipating.
I mean, John, then let's go to the FT where they're talking about Mr. Loeb guessed the election right. He made a lot of money. And I think Mr. Ackman is suggesting Lisa's right. That's what we've seen, and he's betting against it. John, do you see a bet that spreads will widen in credit?
I see a lot of people who are uncomfortable with the idea of where spreads are right now, but not comfortable enough to push the other way. Why? The central bank's in the game, fixing the price. We have a price-insensitive buyer in credit. Tom, you've got to believe that somehow this market can give way to a central bank that's sitting there on the bid whenever anything goes wrong.
And those important discussions John was mentioning with the governors today. Right now, Beata Kerr joins us with Bernstein, A.B. Bernstein, co-head of investment strategies. Beata, we sort of laid out the present land here. How do you write for March of 2021 or investment out all through 2021?
Well, we think about a continuation of the same forces that the market has been reckoning with this calendar year, which is, of course, the challenge of COVID, which is ongoing and escalating, as you've been discussing. But the offsetting force is the fiscal support and monetary support that's providing tremendous momentum and liquidity to the markets. And I think what you've seen over the course of the last week is really a recognition that so many people were waiting for event risk around the election and have re-engaged with the market as there is more clarity around that policy. So I think we have to wrestle with those two forces.
Peter, I think a lot of people are also thinking about whether we would have some regime change on the policy side, away from a monetary policy regime towards a fiscal policy regime. And I understand we've had a mix of both, but I do wonder for you, where you're sitting right now, what regime are we in at the moment on the policy front?
We're in a regime that's been coordinated, and what we saw in the first quarter was an incredible response, both in terms of speed and magnitude, and that is ultimately what gave markets the comfort to start that steady march upward. And then over the summer, it's been frustrating to not see that second round of fiscal stimulus be passed. We really think the economy and ultimately the markets will be looking for direction around fiscal stimulus, a much smaller stimulus package than what would have occurred under the consensus views going into the election of a blue wave. But nonetheless, we do think you'll see in the numbers today that there's still a tremendous number of people looking for work, out of work, that need help. And especially as COVID-19 ramps up pretty relentlessly, we think that fiscal stimulus is going to be critical.
Well, the numbers are ugly in the United States, and the prospect of DC doing more has diminished considerably over the last couple of months, as you've described. What are the capital allocation consequences of that for you right now as you look into year end?
Yeah, well, I'm coming to you here from Chicago, Illinois, where we're the one state in the union right now that doesn't even allow indoor dining, to give you a sense of the escalation and the potential for ongoing shutdowns and lockdowns. So we do see the vulnerability of the economy to ongoing stress from lockdowns. That being said, we are long-term bullish. And in fact, we went into September and the election slightly overweight equities. That has been the right call. And we have trimmed that back a little bit, but ultimately maintaining that position because we see vaccine optimism and earnings recoveries that are substantial in 2021.
So, Beata, let's build on that. Is there an idea then that the virus counts and all of the high-frequency data that people were poring over earlier this year, that none of that matters right now if you've got a longer-term view?
Well, we don't think none of it matters. If you think about what happened in the spring, the market was really focused on a national healthcare crisis and the inability of the system to manage the virus. And what we've learned today, and you've had prior guests this morning actually addressing this, is better treatment, ultimately lower fatality rates, and more targeted economic impact from more localized shutdowns. And I think that's what the market is effectively expecting. But again, we come back to the fact that we do think fiscal stimulus is necessary in some form. The sooner the better. But the odds of it happening this year are being reduced as we speak.
Beata, you always fold a lot of math into this, and I love your phrase, the mathiness of the phrase, the idiosyncratic drivers. Discuss that. What's the new idiosyncratic driver?
Well, in our opinion, as active investment managers for over 50 years at Bernstein, what it means is that being an index investor or simply investing in sectors today is not enough. There are a lot of underlying company fundamentals that you have to look at very specifically. We know that we're in a year where growth has led in an extraordinary way, but even within the growth style, there's growth at a reasonable price, and then there's simply momentum growth, and the valuation differences are huge. And you could say the same thing about value in terms of cyclicals and financials versus energy. So you have to look at the company, its balance sheet, its management team. Ultimately, we're focused on buying enduring businesses. And in the end, we think that focus on stock selection will prevail.
Well, let's talk about that and let's finish there. Just give us an idea of how you do that. Earlier this week, when the positive news around the vaccine came out, the likes of AMC get bids up aggressively. I want to understand the difference between a company that just plays the catch-up trade on a bit of hopium on a Monday morning into Tuesday and something more durable through the recovery that you anticipate.
Well, I leave that hard work to our research analysts and our portfolio managers who are responsible for ultimately kicking the tires with the management teams. But I can tell you that what our PMs have been doing over the last couple of weeks is picking up a little bit more in the cyclical space. But to give you an example, even within technology, for example, focused on semiconductors, an area that we think will continue to benefit from the stay-at-home economy, but ultimately support that reversal to going back to normal. Picking up a little bit more in the transportation sector as well as some of the most beaten down names in consumer discretionary and travel and leisure. So that is how we're thinking about positioning today.
Biddeker, thank you. Always great to catch up. Thank you very much. Of A.B. Bernstein there on this market. On sport, our sports correspondent, Tom Keane, mentioned to me as that conversation was ongoing that actually that play at the Masters has been suspended due to inclement weather. That took place at 7:35 Eastern.
They got to be sensitive, down at Augusta, John. It's not like the British Open where they just play. I mean, I love can I just say, I love the British Open because the rough is like this thick. The putting green is like an inch.
Hand motions for radio.
Real golf.
Augusta's beautiful, Tom. Augusta's just beautiful. That's my favorite tournament.
Tiger's scheduled out at 8:05. Mickelson goes out at 11:37. Sam Snead after 12 noon.
Tom, just quickly, it's really important that weather fades and fades quickly. Sunset in Augusta, 5:27.
Well said.
This tournament moved from spring to November. There are tee-offs on the 1st and also the 10th because they need to get this done quickly before it gets dark. So it's not all off from the 1st. You have a series of players teeing off from the 1st hole and the 10th simultaneously to try and get these rounds completed, Tom.
Can you see me playing golf?
No.
I can see you playing golf. No. Maybe in the car with a beer or something like that. Or something stronger, probably.
Trevino, 68.
You should play with him. Alongside Tom Keane and Lisa Brown, myself, Jonathan Ferro. This is Bloomberg.
With the First One News, I'm Rishika Gupta. The state of Georgia will conduct a hand recount of ballots for the presidential race. Joe Biden leads President Trump by a slim margin of about 14,000 votes out of roughly 5 million that were cast. The Trump campaign has alleged there was widespread voting irregularities, but it's offered no proof. Moderna is now poised to take the spotlight on a coronavirus vaccine. The company says its study has accumulated more than 53 infections that will allow a preliminary analysis of its effectiveness to begin. Moderna didn't predict how long it could take an independent monitoring committee to analyze the data. Oak Hill Advisors founder Glenn August says investors should be looking forward to the changes in Washington in January. August spoke with Bloomberg's Eric Schatzker.
I believe that a Republican Senate and a Biden presidency supported by a Fed that continues to be accommodating, I believe that is a Goldilocks scenario for the markets.
You can see more of that interview with Oak Hill Advisors Glenn August starting at 10 a.m. New York time here on Bloomberg TV. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Rishika Gupta. This is Bloomberg.
This is Bloomberg Best, your weekly review of the most important business news, analysis, and interviews from Bloomberg Television around the world.
Ken Burns, welcome to Bloomberg Big Decisions.
We have always been a mixture of things. We are always stronger for that mixture.
Growth is a way to stay competitive, delight more and more consumers.
Welcome to the Best of Bloomberg Technology. I'm Emily Chang.
They've moved the needle by acknowledging that they have to monitor the content.
What is one word of advice you'll take with you?
Learn how to listen. And that is certainly something that has served me well.
Ankiti, where do you go from here?
It's a huge market. It's a huge opportunity. I want to go 100x from here.
Our philosophy is to partner where we can and stand apart when we should.
A sense of the real-time action, the 10-year yield tumbling now 11 basis points, so continuing in this knee-jerk risk-off feel.
Frankly, the Trump administration has basically given up, and we're just kind of sitting there waiting for the vaccine, and the virus is not waiting. The virus is all around us.
Lawrence Gostin there, Georgetown University professor, on the hopes for a vaccine, the reality of a difficult position this country is in through the next couple of months into year-end and the start of 21. It's the price action this morning. Good morning to you all. Alongside Tom Keene and Lisa Abramowitz, I'm Jonathan Ferro, live on Bloomberg Radio and TV. The story as follows for you. Equity futures down 19. We're negative 0.5%. Bit of risk aversion. We add to the bid in treasuries, 93 basis points on a 10-year. And in the FX market, look, I find the euro move fascinating over the last week. I keep bringing it up. Euro positive as risk appetite declines. When risk appetite picks up, euro negative and the dollar comes back. You've got to get your hands around that. It's important. Euro dollar 117.94, Tom.
I look at the blended index. There's two of them. It's a little confusing, folks. There's the Bloomberg dollar index, which is really good math, has a little bit more EM and China weighting, and then the traditional DXY index. And John, printing a 93. I mean, there's no other way to put it. The dollar doesn't give way here, does it?
People thought it would, and people thought the dollar would give way when risk appetite and a cyclical impulse came back into this market. I can tell you, started this week, we all saw it in a huge way, a monster way. Cyclical appetite returned, a cyclical impulse built up. What happened to the dollar? Not what people expected it to do.
Let's rip up the script here. Ed Mills is with us. We can do this with Ed Mills of Raymond James. Just years of congressional effort in Washington, and of course his perspective now for Raymond James. Ed Mills, Dr. Fauci's out with headlines, and they have to do with the minks and the strains, monoclonal antibodies, and my eyes are glazing over. Ed Mills, is Washington as missing in action as it looks on this pandemic? How alone is Dr. Fauci and the rest of the science community?
Well, I think under the current Trump administration, they are leading with the strategy of trying to get the vaccine, not necessarily leading with the national strategy at this time for containment. That is where I think the market is looking towards the Pfizer news of this week, other positive headlines related to any vaccine or therapeutic development. There is a hope that there could be some fiscal stimulus out of D.C. That's probably the one area where we can act. Getting it done before the end of the year has a lot of hurdles, but I think the market has largely been looking at that debate as it's not a question of if, it's just a question of when and how much. As long as it stays on when and how much, that's a decent view for the market coming out of D.C.
Ed, from your vantage point, how much cohesion is there right now in Washington, D.C.? As you know, John mentions, we basically have a contested election. It has not been officially called yet. The transition team for President-elect Joe Biden has not been allowed in to get national security briefings. How important is this when it comes to crafting policy in the U.S. and passing some sort of fiscal relief?
Lisa, those are great questions, because what we had said is that if we were in a contested election, the ability to get fiscal relief done was basically off the table. Because if you're arguing over an election, getting bipartisan agreement on a $1 trillion or $2 trillion package, that's very difficult. I do think that the sentiment in D.C. is that a lot of what's going on has to do with the runoffs in Georgia, ensuring that the Republican base and Trump supporters remain elevated in their support for those two candidates. But I will tell you, from a market perspective, investors that I talk to think this election is largely over. And they've even somewhat called the Georgia races. People are positioning for a split government with Biden as the president-elect and Republicans in the majority in the Senate in Georgia. It might take a few weeks or a couple of months before that becomes official. I think if there is any doubt, it's those seats in Georgia that I'd be watching.
Ed, I just want to touch on a price action, then we'll return to Georgia quickly. Equity futures down about 20 points on the S&P. We're negative 0.6%. No drama here. In Europe, we do roll over, though, down 1% on the Stock 600. Bottom of the pile, the banks. They were top of the pile over the previous few days, especially over Monday, Tuesday. Banks down by 2.9%. Just something to keep an eye on as we go into the opening bell in New York in about 1 hour and 8 minutes' time. Ed, let's talk about Georgia. You mentioned Georgia and the relevance of a contested election to how those Senate runoffs races may be. Can you help me understand the fiscal conversation, whether that has anything to do with the politics for early January as well?
Yeah, there are more questions right now than answers, Jonathan, in the fiscal debate. Does McConnell want this to be settled before the runoff elections, or does he want to potentially strengthen his hands if it is clear that he will have the majority for the next 2 years? Does Pelosi, do Democrats want to settle? Are there going to be a big fight around the December 11th government funding deadline? What do we do about the December 31st expiration of millions of Americans who are getting federal unemployment benefits? Right now, the most optimistic view I can say is that Pelosi and Mnuchin spent weeks negotiating. There's a lot of language there. You just need to get the political will. But, you know, what does Biden do? What does Trump do? If he's not willing to concede the election, is he willing to support fiscal relief? Yeah, I think everything right now is up in the air, and that's why the market is not focused on the if, it's focused on the when. And there is a belief we get it done. It's my belief as well, but I think we have more uncertainty than I would like right now.
Ed, I can tell you what people in markets think of Washington. Can you tell me what the people you speak to in Washington think of markets right now?
You know, Jonathan, I think there is a humorous kind of a view of each other. I think both at times think that the other is disconnected from reality. A lot of people are wondering how we could have seen this move. One thing that we hear all the time after an election is that almost any outcome, people with assets come up with a reason why that is good for their assets. So, you know, certainly as I look ahead, if it is a divided government, if we get fiscal relief and we're not going to have to deal with some of the uncertainty of a all one party government, that is positive, but it is always interesting to me that without a doubt, we always find a way, if you have money, why this is an okay outcome for you.
Yeah, always finding a way to be bullish. Ed, great to catch up, sir. Ed Mills from Raymond James, thank you. Tom, isn't that the story? Always finding a way to tell a comforting story about why everything's going to be okay and to stay long.
Well, yeah, I think it's called gridlock. And I just really wonder, John, with the news flow we're seeing, and frankly, the market flow as well, where we are, as we spoke to Rob Kaplan the other day of Dallas, and John, some of the seriousness of Lagarde the other day. Do we have time for gridlock right now? I don't have an answer, but is gridlock good going into, say, March?
Gridlock apparently is good, going into March and beyond. Why? Because of the central bankers that you just mentioned, Tom. We've got a market now that is so heavily insulated to fundamentals and risk, and near-term risk as well. How much divergence have you seen on high-yield spreads, Lisa, in the last couple of days? Clearly, the back end of this year is going to be tough.
This is, I frankly,
of the last several months.
Yeah, I mean, this is the reason why people are not that excited about not getting compensated for taking risk. Is a default cycle really over when you have businesses that are going to be forced to shut down, shut their doors in the upcoming weeks and months, John?
The economic data is just around the corner, 5 minutes away in the United States of America. That means Michael McKee drops by, catches up with us and breaks down the figures, and then we'll catch up with Lou Alexander of Nomura, the chief U.S. economist. Heard on Bloomberg Radio, seen on Bloomberg TV. This is Bloomberg Surveillance.
outlook for the economy is extraordinarily uncertain and will depend in large part on the success of efforts to keep the virus in check.
They are torturing themselves to explain that they're there, ready, willing, and able.
The Fed has basically done all it can do, with the exception of extreme emergency measures.
I think what we've seen during this period of time is that communicating via video is not a fad. We are using it in all aspects of our lives, for work, for learning, for communicating, for staying in touch.
I got a message about 60 seconds ago and it said, Lisa, the bear is back. I'm surprised it took 90 minutes, but she's back. The smile just disappeared from the top of the program as soon as we got to high yield spreads and investors not being compensated for the risk they're assuming, and just bang.
Calling it like it is. Calling it like it is.
Data in America. Here's Michael McKee this morning. Morning, Mike.
Good morning, John. Well, we got a couple of different things that we're caring about. Initial jobless claims is probably what most of the market is focused on this morning, and they come in lower than forecast and much lower than last week. 709,000 on a seasonally adjusted basis. That's down from 751,000 the previous week. Let me see here. They revised that up, to 757,000. So anyway, it's down 48,000, which is good news. A lot of people concerned that as the caseload rises from COVID, the country is going to see more businesses shutting down. But as someone pointed out this morning, a lot of them already have. So maybe you won't get nearly the kind of number changes that you had anticipated. On a overall basis, we still have 21,157,000 people who are still getting some sort of benefits, at least as of October 24th. We have more people moving off of the regular unemployment into the pandemic emergency unemployment. That's up to 4 million now. So we are seeing the long-term scarring that Jay Powell has worried about, and we will continue to watch that. He is speaking this morning, 11:45 New York time. He's talking to the ECB Sintra group. CPI is out this morning, comes in flat for the month. That was a surprise. We thought it would be up by at least 0.1%. Core is flat as well, and so we see both the year-over-year numbers for core and for the headline go down. 1.2% increase for the headline number, and on a core basis, 1.6% for the year. Taking a quick look at where we saw changes in that, the biggest drop seems to have been in medical care commodities, down 0.8%, which is kind of a surprise there. And we also see apparel down 1.2%. And I did want to mention for Riley Dabbs, our producer, that diamond prices rose last week for the first time in several weeks.
Oh, that's very interesting.
Something we didn't know.
Is this something we didn't know, Michael McKee? Had no idea.
St. Louis coming up.
Should be continued.
You know, burying the headline, as they say. John, let's look at the data right now before I get back to Mr. McKee here. Yields come in with a vengeance. I mean, we just come right back through the election upward, 0.9258. John, pick it up on what you see in the data.
I mean, I'm laughing. I'm not sure if Riley's parents follow this program, but they might be a little bit concerned right now about what they didn't know. Here's the price action in the bond market. I want to turn to 10-year yields. We roll over just a little bit. We had a bid on the 10-year. We had a bid on the 30-year. We had a flatter curve. Just add some fuel to that with that downside miss on inflation, Tom. So yields coming in 4 or 5 basis points on a 10-year. This is the challenge, that Treasury range. We're at the upper end of it as we went into Veterans Day for that bond market closure, and we come out the other side of it. Bid returns, yields lower again.
Yeah, absolutely. No question about it. I mean, the yield comes in, and there it is. Mike McKee, what's so important here is weaker aggregate demand. We're going to go to Lou Alexander, but Mike, one more shot here. We're going to assume a weaker aggregate demand, Rob Kaplan says, for 2 quarters. Does that mean disinflation that lags into 2021?
It means at least a kind of a cap on inflation, probably. It's hard to say necessarily whether we'll continue to get disinflation. I'm looking at the more detailed CPI breakdown, and there are a couple things that stand out. Medical care, which is a little bit odd given the situation, but when you look at gasoline prices down, we've seen a lot of volatility in energy costs, and that's not likely to necessarily continue or to go much lower. We've gone up since then, so we may see a little bit of pressure on headline inflation from that. And the other thing that people have been watching closely is rent of primary residence, owner's equivalent rent. That's up 0.2. That's an increase from the prior month. People have been wondering about house prices starting to go down if everybody's moving to the suburbs in cities, and then house prices going up in the suburbs. It looks like we're not really seeing a whole lot of change in the trend there.
Michael McKee, thank you so much on inflation, and of course on the claims data as well. We'll have much more on that through the day. Right now, Louis Alexander joins us with Nomura, their chief U.S. economist. Lou, are you writing about the next 2 quarters? Are you thinking more farther out past that?
Well, look, I think the next couple of quarters are important, in part because you've got 2 things going on. You've obviously got COVID drag. We're on the cusp of seeing, I think, more changes in behavior, potentially more lockdowns. And it's important to see how that's going to affect activity in coming weeks. You've also got fiscal drag. And the fiscal support that was provided earlier was tremendous in terms of how large it was and how quickly the money got out the door. But the downside of that is that support rolls off relatively quickly. Obviously, the politics is going to drive how quickly we get that replaced. Look, beyond the next couple of quarters, you've obviously had good news this week with respect to an effective vaccine and the potential for us over a longer horizon to get back to normal sooner than we might have otherwise. But we got a big hump to get over.
Lou, I'm struggling with this idea that earlier in the year, people were paying attention to these jobless claims with detail. These were the leading indicators, and people were looking at these as a sense of how much permanent damage, how much scarring there would be long term. Now people are saying it doesn't really matter because we're going to get a vaccine and everything's going to be fine. But does it still matter when it comes to gauging the scarring, gauging how much slower growth will be over the years to come after the pandemic is already gone?
So look, the weekly unemployment data we get is some of the best high-frequency data that we have. You know, we have a long track record on it, and we can sort of track it. And so I think it's very important in that context. I think the fundamental question of how much long-term damage there's going to be is a harder thing to gauge. The weekly employment data help us, but frankly, the monthly data are important to that as well. And that is going to be an important issue because the question of what we get back to as the new normal is going to be critical. And we're still figuring that out. I mean, frankly, businesses are still making decisions about to close. I can't stress enough that 700,000 claims, initial claims a week is an extraordinarily high number. The fact that continuing claims are stable in an environment where you have that level of initial claims means that there's a lot of hiring going on as well. And we still are just in a very disrupted state. So I think those numbers continue to be important. Like anybody who would argue that's not important to how you think about how things are going to evolve, I would push back on that.
Lou, have we got any historical example of this amount of churn for this length of time?
No, short answer. You can go back. We have decent quarterly data on labor markets going back to the 1890s. There's nothing like what we've gone through this year in terms of both the increase in unemployment we saw in the spring, the rapid declines we've seen subsequently. There really is nothing that's comparable to this. That includes, I would note, the flu pandemic a century ago. So we're really in uncharted territory here. It's clear that from a dispersion perspective, the thing that's really remarkable is how in parts of the economy, they've just been severely disrupted. So you're still 50% down in things like travel and those kinds of areas. How that's going to come back remains very much in question. But we really there is nothing we have in the historical statistics that's really comparable to this.
Lou, really sobering. It's great to catch up with you, just to work through these numbers. Lewis Alexander there from Nomura. Thank you, sir. Just getting a headline from an interview conducted with CNN just moments ago. The Ohio governor, a Republican, Governor DeWine, saying the following, Tom. Biden is president-elect. Not the first Republican to say this, but it's notable. And I know it might be a surprise if I told you this a few months ago, that if we had a president-elect Joe Biden, it would be notable that some people would actually recognize him as that. But that's where we are. Governor DeWine saying that Biden is the president-elect.
And I would say is concerning both for his supporters and those not, is a president, about 7:06, the Washington Post has a president with no events scheduled for today. I'll be honest, John, that's concerning. I mean, he was there for the Tomb of the Unknown Soldier and the Veterans Day affairs yesterday, but another day without communication seems challenging, to say the least.
Well, Tom, let's pick up on that word concerning. When you say it's concerning, what about it is concerning? On what particular topic is it of concern right now?
I have an immense respect of how the United Kingdom does this. You lose the election, you're out the next day, or however you do it, John, really across the United Kingdom. Here, there is a tradition. The president's clearly decided to break that tradition. There's no question about that. And for a lot of people used to the tradition, the cadence, the method, the visits that are made, it's all got to get cleared up in the next couple of days. And the governor of Ohio making a statement is maybe one of those small steps towards where we get back to a cadence we all grew up with.
The United States has got to work through a huge transition of government.
Right.
It needs the time to do that. We'll work through that process. What this exposes, though, Tom, at a critical time for this country, is maybe how questionable that 3-month period actually is. In the midst of a pandemic, with no agreed federal response right now for the new wave of infections and a very staggered approach from states so far. Massachusetts, Utah, New Jersey, New York, problems down in El Paso when you're thinking about at the county level as well, Tom.
Yeah.
Thanksgiving's just around the corner. Huge amount of travel coming up in America. And you do wonder, Tom, how quickly they might have to move.
Yeah, I think that's all accurate, John. I would say that, to me, the granularity right now is really important. As I mentioned earlier, if you're in Idaho and you're sick and you're supposed to go to Salt Lake City, well, that's maybe not happening now because of the hospitalization challenges. John, I know you're going to mention our wonderful guest coming up. I really want to say to everyone, this is the interview I've tried to have for the past 3 days. Because of his schedule, John, General Kimmett couldn't be with us until now. But he knows these people in the Pentagon that we're all studying and learning about right now.
That conversation comes up next on this program. Brigadier General Mark Kimmett, the former Assistant Secretary of State. From London and New York this morning, good morning. Alongside Tom Keene and Lisa Abravitz, I'm Jonathan Ferro. Heard on Bloomberg Radio, seen on Bloomberg TV, with an equity market down 10. Called it 11 points. We're down about a third of 1%. We recover just a little bit. 50 minutes out from the opening bell this Thursday morning after an epic start to the week, and then it faded just a little bit. Is it another head fake, that rotation into the cyclical parts of this market, or is this the real deal? Tough 3 months ahead. That one is for sure. This is Bloomberg.
With the First Word News, I'm Rishka Gupta. President Trump suffered 2 setbacks as he tried to claim victory in the state of Arizona. The state's Republican Attorney General told Fox Business it was highly unlikely the president would catch up when remaining ballots are counted. He also said he has found no evidence of widespread fraud that the Trump campaign has alleged. And President-elect Joe Biden has stocked his transition team with policy experts, academics, and former Obama administration officials. That's a contrast with the industry-friendly figures that President Trump appointed. Biden's team includes people who favor stronger government regulation than the current administration. Still, liberals are concerned about the number of tech executives Biden has included. The American pandemic's longest increase in coronavirus infections appears poised to get even worse. The nationwide rise in cases is now in its 9th week. Authorities reported more than 145,000 new cases yesterday, an all-time high, and the 7-day average for deaths has climbed above 1,000 for the first time since August. Disney analysts are bracing for another tough quarter. The world's largest entertainment company reports fiscal fourth quarter results after the closing bell today. Wall Street expects Disney to report a 26% decline in revenue from a year earlier. The coronavirus pandemic continues to ravage the company's businesses, but Disney's streaming service could provide a bright spot. China and 14 other Asia-Pacific nations are close to a deal on the world's largest free trade agreement. It could be completed this weekend. The partnership also includes Japan, Australia, and New Zealand. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Rishka Gupta. This is Bloomberg.
Generation's biggest problem.
Climate change is happening.
and the world's most innovative solutions.
Transport, industry, buildings, electricity, all of those things.
Everything you need to know about our changing environment, the politics of global warming.
We can and we will deal with climate change.
In the fight against climate change, Bloomberg Green has you covered.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
I'm David Weston. Bloomberg Television is reinventing one of the most iconic brands in financial television for a new audience. Join me to see the news program for the clever investor. This is Bloomberg Wall Street Week.
There's plenty of threat out there. The Pentagon is in disarray on the civilian side. Again, the good news on Veterans Day is the uniformed military is on the job and on watch. We'll get through this, but it is a very turbulent, choppy time.
Good morning, everyone. Bloomberg Surveillance. Lisa Abramowitz and Tom Keene and John Farrow as well. He's off getting ready for the open here with a market negative 11. I have anticipated this interview since I spoke to James Stavridis a number of days ago. General Mark Kimmett is the rarest of rare, someone with a distinguished military career who's dovetailed it with State Department experience. We're thrilled that General Mark Kimmett could join us right now. General Kimmett, the name blur right now is off the chart. We have a general here, we've got a colonel there, we've got Alyssa Slotkin out of Michigan with her Defense Department experience, and all of this name and this cacophony comes down to one thing. How is the Pentagon doing? What is your feeling of how the Pentagon is doing in this immediate turmoil?
Look, I think the uniformed services are doing just fine, as Admiral Stavridis said. You can be sure that Mark Milley has got the rudder in the boat, moving them straight and in the right direction. I am a little concerned about what's going on in my old policy shop in the Pentagon and the Intel shop and the Secretary of Defense. Something doesn't click here.
What is the price or the good or the negative of an Afghanistan exit? Clearly, the zeitgeist is the president desires that. We hear a silence from the military. Give us the calculus if we were to exit Afghanistan.
Well, on that particular issue of Afghanistan, Zal Khalilzad is doing some great negotiations, but he's negotiating with the Taliban. The fact remains is we are coming to an agreement where the Taliban say, you leave, we'll take care of al-Qaeda. We know that's not going to happen. And the United States is saying, if you take care of al-Qaeda, we'll leave. And that's not going to happen. I mean, if there is an al-Qaeda threat or any other ISIS threat inside of Afghanistan, we will come back in. It may be from the air. It may be with select special operations units. But the fact remains is we are not going to allow Afghanistan to remain and become again a safe haven for terrorists. So this kabuki about pulling all the American troops out, we'll pull the ones that are sitting around the bases not doing much, but the ones that we need to have there to work with the Afghan National Security Forces in counterterrorist operations, I'm not worried about that.
Under the revolution, it was Goldwater-Nichols, 1986, really the last act of Senator Goldwater, create a real structure and separation of our military. How confident are you that the military can operate over the next 69 days?
I'm not the slightest bit worried about that. I mean, Goldwater-Nichols was a result of the clown college that we called Grenada, where you had every service doing their own thing. Since then, since 86 in Goldwater-Nichols, it's a very smooth running military setup, going from the president to the Secretary of Defense down to the combatant commanders. That's not where I'm worried about right now. It's from the combatant commanders through the Secretary of Defense and up where I have some concerns.
All right, can you elaborate, General, on your concerns, what the practical implications of some of the turnover may be?
Well, I'm not concerned about the practical implications. I'm concerned about the people. I think you take a look at the record of Tony Tata, Doug McGregor, Ezra Cohen-Watkins, Stephen Miller. I don't know the Secretary of Defense, but these are guys that have a great military background, but it seems their greatest qualification for joining the policy shop is that they appeared on Fox News on a repeated basis, probably echoing back to President Trump what he wanted to hear.
Does this have immediate implications or long-term implications in terms of a greater politicization of the entire military forces?
Oh, that's not going to happen. I mean, Mark Milley and the team will resign before they become political bozos. What I am concerned is and this is purely speculative, I've got this sneaking suspicion that something's going on here in terms of why these people were brought in. And I think it's far more than just Afghanistan. These are people with a deep loyalty to a president who has 60 days left in unfinished business. And I'm just hoping that the Secretary of Defense is not going to give actions and orders to the military in the next 60 days that are going to haunt us for a while.
You have a great experience with Colonel McGregor. As you mentioned Fox TV, he has, of course, been a contributor there as well. Can you describe, if Colonel McGregor enters the Pentagon as a citizen, how he will relate to the Joint Chiefs of Staff?
Again, what I'm concerned about with Doug is not relating to the staff as a civilian. I mean, there's great respect for ex-military among the Joint Staff. It's what is being planned and why he was brought in. Doug McGregor is brilliant, but he's got some very strong views. I worked side by side with him over the years. I worked for him in one job. He is creative. He thinks outside the box, and I just wonder what he's thinking outside the box right now for the next 60 days.
General Kimmett, thank you so much for joining us today. Under some duress, we're thrilled we could find the time to speak to Mark Kimmett. Right now, we need to look at the markets. At least I noticed, I believe, CNN with a helicopter crash in Egypt involving U.S. personnel. We'll follow that. That is breaking news right now. Lisa, just so interesting to see, again, the cacophony of news and the resiliency of the market. It's almost like, Lisa, the market's the only thing that's transparent right now.
Well, right now, the transparency is that people are shrugging off, at least in markets, shrugging off some of the turmoil that we're hearing about and seeing in Washington, D.C. You do wonder, though, what the implications are at a time of a virus that's getting worse, at a time of economic uncertainty when we're looking for a fiscal support package, that there is such dissonance in Washington, D.C., as we were just hearing about. It's uncomfortable, but markets are looking past it all.
And Lisa, critically, and we say this to our simulcast, good morning, Bloomberg 1130 on radio, on television as well. Lisa, you and I are frankly focused on the 5 boroughs. We've been doing better than the rest of the country in this virus, And you really have to wonder, is that going to change in the coming days?
Yeah, what Dr. Koh is talking about, the exponential factor of the virus, that you only find out that you are on that trajectory potentially too late if you don't do sufficient testing. What does that look like? If you get another shutdown, how damaging will that be psychologically, if nothing else? And people are looking past this time. Tom, it's going to be a rough few months.
Well, certainly it appears to be a rough few months. Part of that is I have to cook for Thanksgiving, which
I've been hearing about.
Will be a rough few months.
Or not to
brine?
brine?
It's Shakespearean. To brine or not to brine?
That is the question.
That is the fight at home. Right now, let me do a data check here to salvage this, folks. Futures negative, it's the only fight. Futures negative 12, Dow futures negative 217, and the NASDAQ 100. This is important, folks.
Yes.
We had the juxtaposition for a few days, and now we've got NASDAQ 100 reverting to its growthiness, if you will, away from value. The 10-year yield 0.9275 comes in on disinflation tendencies at 8:30. Stay with us through the day on Bloomberg Radio and Bloomberg Television. Governor Cerullo in the 12 o'clock hour. This is Bloomberg.
This is Bloomberg Best, your weekly review of the most important business news, analysis, and interviews from Bloomberg Television around the world.
Ken Burns, welcome to Bloomberg Big Decisions.
We have always been a mixture of things. We are always stronger for that mixture.
Growth is a way to stay competitive, delight more and more consumers.
Welcome to the Best of Bloomberg Technology. I'm Emily Chang.
They've moved the needle by acknowledging that they have to monitor the content.
What is one word of advice you'll take with you?
Learn how to listen. And that is certainly something that has served me well.
Ankiti, where do you go from here? It's a huge market. It's a huge opportunity. I want to go 100x from here.
Our philosophy is to partner where we can and stand apart when we should.
Valuations, particularly, sort of the technology landscape, have gotten to some pretty extraordinary levels. So I think it's not a surprise. I don't think it's any indication of the beginning of the end, but I do think markets don't like uncertainty.
We explore the trends, investments, and competition of the European ETF industry. Join us on Bloomberg ETF IQ Europe.
from New York and London for our audience worldwide. Good morning, good morning. The countdown to the open starts right now. 30 minutes away from the opening bell with equity futures down about 0.25% on the S&P 500. We begin with the big issue. Increasing COVID infections rattling the United States, pushing officials to introduce new measures to slow the spread. New York ordering bars and restaurants to close at 10 p.m., limiting indoor gatherings to 10 people as fresh curbs take effect today in neighboring New Jersey. Governors across the country in Utah, Nebraska, Ohio and Massachusetts all ordering mask mandates in the past week alone, while the country's most populous state, California, starts scaling back tiered reopenings. The growing concern leaving markets and market participants grappling with the darkening near-term risk and a brighter outlook in 2021.
America is caught up in the second wave.
There is a lot of uncertainty around the profit outlook for markets.
Equity investors are already looking at 2021.
The vaccine news is very good news in 2021.
We could see the economy doing much better by the end of 2021.
2021, we will see an acceleration in growth.
We will go into 2021 with more optimism.
But I think there's a lot to get through first.
When we look near term, there are lots and lots of challenges.
The resurgence of the virus is beginning to make new worries.
I'm a little bit bearish in the near term.
Volatility will still stay high for the weeks to come.
There's too many hurdles for the market to cross.
As an equity investor, I mean, do you look at the near-term challenges or do you look at 2021?
This is the story of the moment. Do you trade on the near-term risk or the long-term hope? Joining us now, the team, Bloomberg's Kelly Lyons and Sarah Ponzek. Kelly, let's start with the data on the COVID front. I keep saying this every single day. It is not pretty, and once again, it is pretty brutal.
Yeah, John, the pandemic has gotten worse, not better, over the course of the fall. When you take a look at just the numbers in Europe, they're just a few weeks ahead of the U.S. in terms of its surge. The numbers both here in the U.S. and, of course, across the Atlantic have surged exponentially. Now, Europe did take measures to stem the outbreak, closing non-essential businesses, bars, and restaurants. And as a result, the number of cases are beginning to slow in places like the U.K., Germany, and France, though they still remain elevated. And German Chancellor Angela Merkel said today they are still too high, and as a result, restrictions may last into December. Now, here in the U.S., we did set a record number of virus cases, daily cases yesterday. Hospitalizations have climbed more than 10% in just 5 days across 6 U.S. states. And the numbers are particularly startling in the Midwest. The number of cases per 1,000 people in the double digits across Nebraska, Wyoming, Iowa, Wisconsin, and the Dakotas over the past 2 weeks. Now, here in New York, the number is not quite that high, but we are approaching that 3% positivity rate that would shut down schools. And whether or not it is more restrictive measures or concern about contracting the virus, we are starting to see activity slow here in North America. If you just take a look at retail traffic, well, it had staged a recovery off the lows back in April. It is starting to slow once more. And as a result, eyes of the market are turning to what could potentially restore confidence a vaccine or potential vaccines. We, of course, got positive data from Pfizer's candidate out at the beginning of this week, and now the street is awaiting results from Moderna, which is expected to get data on its own candidate in the coming days. Now, Moderna is using a similar therapy to Pfizer's vaccine candidate, which was successful, proved successful, so experts are expecting Moderna's to be as well, John.
Kelly, thank you. Let's build on that situation with COVID. And Sarah, I'll ask the question of you that I've asked many people over the last couple of days. How much bad news will this market be willing to ignore on the hope that 2021, the back end of it, looks better?
Right now, the market seems to be able to take it in stride. If you look at what we have been seeing over the past week, over the past couple of days, sure, we saw the rotation fade a little bit yesterday. We are seeing it fade once again today. But the movements, the detractors that we are seeing really do not compare to the boost that we saw in the risk-on rotation trade. So to this point, the optimism over the vaccine is outweighing the risks from rising COVID cases and fresh restrictions. We see this on a sector basis too. If you look so far this week, your best performing sectors in the S&P 500, energy stocks up 16%. That would be your best week on record if this were to hold. Financials up 8%, the best since June. Then you look at the bottom of the pack, communication services, technology, and consumer discretionary. Of course, these are your 3 S&P sectors that house your popular FANG stocks. At the same time, we've also seen a broadening of the rally. For example, we hit a record high for the equal weight version of the S&P 500 this week, but not the market cap weight version. Also, if you look at the percent of stocks in the S&P that are trading above their 200-day moving averages now, that stands at around 85%, the highest since January, the second highest over the last 5 years. I'll also point out the Russell 3000, that includes small cap stocks within it too, 80%. 20%. That is your share, and that is the highest share since 2013. So sure, we have plenty of headlines that could pose a short-term risk, could pose a long-term risk too, as we see COVID cases rising, but we're not seeing it reflected in the markets just yet, John.
Sarah Cayley, thank you very much. I want to turn to the markets this morning, 25 minutes out from the opening bell. We set up as follows. Sarah walked you through it there. The outperformance we've seen in small caps. This morning, it's the underperformance. We're down 0.7% on the Russell. The outperformance in big tech, replacing the underperformance of big tech. The Nasdaq up by about 0.2%. The S&P living somewhere in between, down about 1/3% on the session. 25 minutes away from the opening bell. Here's what John Hancock's Emily Rowland has to say, encouraging a diverse approach in response to the latest virus developments, saying the following: investors don't need exposure just to the reopening trade or just the stay-at-home trade. They can coexist. We wouldn't completely abandon tech, communication services, staples and healthcare to chase energy, materials and other reopening cyclicals. Industrials is our favourite reopening sector. Emily, I'm pleased to say, joins us now for more. Emily, let's start there. The tug of war that we're both describing right now, the best way of navigating it.
Yeah, so many cross currents right now impacting the markets. We've got this great long-term news on the vaccine front and the reopening narrative here, but of course, significant shorter-term challenges. And look, the data for the month of October from a real-time basis was actually pretty decent. It's certainly going to get harder here in our view as we head into November and December. So we continue to advocate for a balanced approach. We've been hesitant to get into that more cyclical camp and to really play the reflation trade fully. We want to have exposure to value. We want to have exposure to the reopening trade, but you've got to marry that with quality growth stocks. And we've continued to prefer sectors like communication services and technology in order to do that. And to, it's so easy to get whipsawed here as the headlines continue to move. And we do think that balance makes sense.
Well, let's talk about the balance. You talk about quality growth. Can we talk about quality value, quality cyclicals as well? You saw the dash to trash on Monday to companies, to equities that were near bankruptcy over the last several months. Can you walk me through where you want to get that cyclicality, that cyclical exposure that goes beyond just a catch-up trade and you think is something that's more durable through the length of the recovery, through the cycle that's just around the corner?
Sure. So one of the ways that we're thinking about risk management in a portfolio is by really embracing areas, first of all, like mid-cap equities, which can see a nice bounce coming out of recessionary periods. And we don't need to really
carry on as we were before. Do you think something has really changed now?
Yeah, thank you, Katie. And I think it is so important when we think about getting back to normal that we're not thinking about returning to the normal that we left. The world has changed fundamentally, and we're still understanding the implications of those changes. But I think one thing that that Jean-Jacques had mentioned is that this is a trend that was already underway in terms of the mainstream of ESG, and I think this is one of those trends that COVID has accelerated. Just like working from home and many other things about our lives that are different. We see, if we had this conversation a year ago, many large mainstream investors would be talking about ESG. Many more are today, but it's also in a much more kind of integrated and holistic way. I think Angela spoke about the interconnectedness of issues, and clearly this year has had a series of crises: a public health crisis, a financial and economic crisis. Of course, the elevation of a racial justice crisis that has been long underway, as well as, of course, highlighting the climate crisis in very, very visceral ways. And we're seeing the ways that these are all connected to one another. And I'd also throw in something that's so important, which is this crisis of trust and confidence. So I think that the expectations for business and investment are shifting. People are expecting more out of companies. People are expecting money to do more than just make more money. And so I think that we are now looking at a much broader view of the relationship between companies and society and the planet. And my hope is that that leads us to a view where our interests and efforts are much more integrated and interconnected as well, where we invest in a way that actually reinforces what we want to see in the world and kind of builds greater sustainability and greater inclusion. And I really appreciate all the remarks that have been surfaced today, because it starts to speak to the ways in which that can happen in a very pragmatic way for asset owners and asset managers.
I mean, Guido, I know that this is something that Swiss Re has been focusing on for a little while, but has this really strengthened your resolve, what we've seen over the course of this year?
It's clear the topic of ESG is not a new one for Swiss Re. Just think about climate. Swiss Re is the biggest nat cat reinsurance globally. That's why environment, climate was always very, very close to our heart, but also social resilience. And that's why we always kind of focus on all three letters. And then the main question is how we translate this to the investment side. I'm the Group Chief Investment Officer at Swiss Re. And I basically took up the ball a few years ago. And in 2017, we did a big shift on the asset management side, in the sense that we introduced ESG basically as our benchmark even to the portfolio manager and us as a unit. And I have to say, 2020 is another proof this was a very good decision. And as an investor, I'm more than happy, and I quickly want to share with you the figure just of the first 9 months of this year, which were kind of really volatile months. But in this time, we could outperform on the equity side by 1.1% over traditional equity benchmark. And on the credit side, and talking about the investment grade quality, it was 20 basis points. These are big outperformance figure. And now we have a few years of experience in Swiss Re in managing our whole assets according to ESG, and it really pays out overall, but particular in volatile and very choppy markets as we had this year. That's why it paid out for the company, but hopefully also for the broader society. Now, what is also very much kind of reconfirming our decision, what just Jean-Jacques has mentioned, the trend. If this year we basically reached the 1 trillion figure, the 1 trillion of assets are managed according to ESG globally. And as Jean-Jacques also has mentioned, even in the most volatile times, we still had inflow into ESG type of products or benchmark definition. And the inflows in the worst kind of 3 months of this year, between April and June, was basically another over 70 billion of assets. Now it's clear, and I fully agree also with my fellows on the panel, the S has become more important this year. Again, we were aware that the inequality is a very important pillar. Again, it's also access to healthcare, but it's just also the inequality more broadly, and clearly also people of color. These are topics which came to the top of the attention, and COVID really showed that the spectrum is much broader than just climate. But coming back, I'm very optimistic, because we experienced a year full of crisis, and it shows some of the factors will not go away. And personally, I see a lot of assets with long-term investor, and that's the opportunity to channel those money, as Angela already started a while ago in her pension fund, channel the money towards something which is resilient, which is really promising. And on top of the long-term investor, we have the biggest stimulus program ever by government, and this is 10 times bigger than in the great financial market crisis. And again, if you can direct 10 trillion to something which is more sustainable, there isn't any better time than to really focus on ESG. That's why also there's very optimistic outlook what we can do now.
It's an excellent point, right? Because it's not all about where government can direct money. If they direct liquidity into the system, then it's in the hands of private sector investors to push it into places where it can be of the most benefit. And that does strike me as an interesting shift. I mean, I'm interested in what the scale of the opportunity is here. I mean, Angela, can you talk a bit about the scale of the potential impact of the different way that you've been investing over the years? How do you assess what I hate the phrase, but what does success look like for you? How do you know what difference you've been able to make?
Well, I think because we invest in diversity, and I think maybe in the U.S. We're kind of a little ahead with diversity while we're still playing catch up, with the overall ESG framework. And for us, it is about diversity being a priority. And we're often asked, how can you measure that diversity is making an impact to your portfolio. And we feel, and we're challenged, as to if you're investing this way, are you truly being a fiduciary to the fund?
Yep.
And, I say to that, because we are investing this way, that is being a fiduciary to the fund. It is a strategy just like ESG factors, just like any other strategy that you would, integrate into your portfolio. And because of that, we understand that diversity yields, positive outcomes.
Oh, I think Angela may have, Angela may be freezing a little bit.
Larger managers and being natural diversifiers in our portfolio, which diversification is the key to having, outcomes or positive outcomes over the long term.
Right. She really has frozen now. So let me turn that to Jean-Jacques. Do you think the fund management industry in Europe has something to learn from that experience that Angela describes? Is Europe somewhat further ahead on the E and the G, but perhaps lagging on the social side of this equation?
I think it's a very good question. I think if you look at, I think on diversity part of things, I think an inclusion and social inclusion, I would say probably. The question is that you have a very, I would say, different perspective on what social means, depending on the side of the Atlantic you are. And I think this is something that needs to be acknowledged. If you look, for instance, at referring to what Guido just said, for instance, something we put really at the heart of the way we assess companies according to the S criteria would be about more and more the question of social inequalities. So basically how a company can participate to the reduction of social inequalities in the way it behaves as a corporate. I give you a very practical example. For me, the best way to participate to the reduction of social inequalities first as a company is to pay your taxes properly. And therefore, something we are assessing, for instance, in the portfolios, not in all of them, but in a number of them, is the difference between what a company is supposed to pay according to the tax regime that is applicable to this company and what it effectively pays. I would consider that this can create a very strong debate, maybe even among us, on is this what we want to address when dealing with the S question. So to come back to your question, I think on the environmental part, particularly on the climate part, as we have something like almost 30 years of experience since the Rio conference on climate in particular, I think progressively we're moving in the direction of more harmonizations of concepts and metrics that we can focus on, and I think that's great. When it comes to the S part, I think there's still a long way to go. But the good news, as Guido was mentioning, is that clearly I would say the trend is there, and that investors are paying more and more attention to that.
I mean, Guido, do you think it is time for European asset managers to think about allocating funds specifically to minority-owned companies, to have some sort of targets around this?
I'm strongly convinced that you need to have an inclusive type of culture in each and every company. Just in order to be competitive, in order to have growth, that's a key success factor. We apply it for ourselves, but I'm pretty sure this is also an important factor if you assess a company. That's why what it really starts that this factor, be it the social, be it the inclusiveness, is somehow flowing into a company's analysis. And only then it starts also to show what is the value of it, or what is the downside risk. And I always look at on a risk-adjusted basis. And to have a culture which is not inclusive is clearly, you face much higher kind of downside in going forward. And no doubt, the S is the most challenging one to quantify. Governance, we know since I guess decades, if not longer, if you have a bad governance, this kicks you back in sooner or later as a company. We had too many examples of that. That's probably the letter which is most common. And also there you have all the stats which you need to have. The environment is coming also to the forefront in having all the quantifiable aspect to make sure that it's part of a financial analysis. The S system, yes, it's the most soft one, but it's for sure it's the one probably which needs a lot of attention. But only focusing on S and basically moving away from the attention of the environment it doesn't solve the long-term equation. That's why we strongly believe you need to drive both as a social as well as the environment. Plus governance is an existing topic since ever forward. And I think you should also assess a company, but also ultimately also an economy or a sector based on all factors. And that's why for me, this always looking from an investor point of view, I'm looking for the right investment opportunity. And of course, if I can help to transition the world, which is more equal, more inclusive, and basically make sure that we have a scheme which works globally from an investor point of view, we achieved a lot. I always say the institutional money is big, it's sticky, but it needs direction. And that's why looking not only at financial return, but other factors which influence the risk profile of a company, a sector, or ultimately also of a country is of key importance.
I mean, Amit, you've touched on this point also that Guido made, which is that the different elements all have to work together. But how do how do people do that in real life, and how do you measure the positive impact that you may be having there?
Well, it's such an important way to think about things that we can't kind of tease apart all the different social and environmental issues we're facing, but really recognize how, for example, climate change will affect lower income, more vulnerable and marginalized groups more than wealthier ones. And so addressing climate change is part of addressing inequality and vice versa. One of the things that we focus on with the GIN is really trying to drive capital towards investments that drive positive impact. And that can be across any number of sectors, housing, sustainable agriculture, forestry, clean energy access, and so on.
So it's not just about avoiding the negatives, it's about directing at the positives, right?
That's right. It's not just about avoiding harm, and it's not just about mitigating risk. Those are all very important, but it's also about how do we drive positive impact, for example, towards the achievement of the United Nations Sustainable Development Goals. We have a system that is called IRIS Plus. It's IRIS with a plus sign, and it's a comprehensive system for measuring and managing impact. It's free, it's online, and it's used by over 13,000 people all around the world to manage their positive impact for investments or for companies. And one of the things that we look at that's so important is also just the different dimensions. So if you're thinking about social inclusion, we've seen investors over the past few years focus much more on gender than on issues of racial justice. That, of course, is changing with the events of 2020. But there's also multiple dimensions to look at within one. So you can look at like who owns a company or who's in leadership. But you can also look at who's employed and what opportunities they're creating for different populations, and also who's served by the underlying the products and services. So where is the company directing its efforts in terms of the markets it serves? And all those have impacts on things like gender inclusion and racial inclusion. Another thing that is really a big shift that's underway now is we often think about the number of jobs as the metric for success in terms of economic development. You'll hear politicians talk about it, corporate CEOs, but this year has really surfaced the need to focus on the quality of jobs. So many working people were so vulnerable, despite the fact that they had full-time jobs and worked incredibly hard. And so we've been doing work supported by the ILO on developing metrics for quality jobs, looking at the different dimensions of employment that are measurable, that are quantifiable, that can help a company or an investor understand the impacts of their investments, on employment and on economic livelihood.
Yeah. That is a really interesting point, that we keep collectively thinking of new metrics that we hadn't thought of before. And that kind of goes back to the issue that always comes up when we talk about ESG investment, which is measurement. You know, the whole topic of this discussion is beyond box ticking, but nonetheless, those boxes do need to be ticked at some point. How do we make sure that we are kind of all moving in the same direction? And does it really matter, honestly, if we're not? I mean, if people are generally trying their best, but they don't all necessarily subscribe to precisely the same framework, is that okay? I mean, what do you think, Hamid? Is it possible for everyone to all be aligned on this?
Well, what we think is so important is that we have standards on the actual metrics that we're using. And that's important. So we're all speaking the same language when we talk about something like impact on climate or on inclusion. But I think it's important that that sets the stage for a lot of innovation and differentiation around what people emphasize or what their strategies are for driving the greatest impact and value. Think of just like we have financial metrics that are commonly used around the world. That doesn't stifle innovation in business models. It just allows us to focus the attention and understand different ways of measuring performance of one project versus another. What I do think is important, though, on this box ticking question is that is something that we have seen as the trend to this point around, everyone needs to be able to say something when it comes to ESG or impact. But what I hope is a shift coming out of this year, and we're already seeing the early signs of this, is a focus not on compliance or checking a box, but one on performance. So how can we use the data and metrics to drive greater performance when it comes to things like inclusion or gender equity? How do we actually drive a race to the top? So investors are saying we're outperforming the market when it comes to impact on a given issue. And that's the work that the GIN is actually focused on, is developing. We have the standards through Iris Plus, but how do we actually develop the methodologies to actually compare and benchmark performance? We actually just published a methodology today, coincidentally. It wasn't planned for this event, but we've been doing some work with investors to actually benchmark and compare impact performance data, which I think will hopefully drive a lot of great activity in this direction.
Yeah, it will be an interesting day when I start getting press releases about fund managers or investment firms boasting about having had a bigger social impact than the rest of their peers. That would be a kind of an interesting step change. We'd just like to remind viewers to please post questions. We will try and answer them at the end.
Actually, just if you allow me quickly, just to build on what Amit just mentioned, I think it's super important that not each and every company, each and every investor, each and every sector defines its own standard. This would be, I always say, this would be waste of time, energy. It would be dilution, and that's why I think everyone should join platforms. And at least my intention is always to choose those platforms which have, let's say, a passport or an outreach as big as possible. And that's why we engaged with the EU technical experts group to define climate-related benchmark. But I think other examples are the DCFT effort from the FSB. These are just examples, but for me it's important that all the relevant stakeholders, and I think this panel is a perfect representation of different stakeholders, that we join up with the public sector to define what is the most meaningful template and standards. Because otherwise, probably we do all the right thing or try to do the right thing, but we can't really channel the good energy and the great efforts which we all have. My big call is, yes, let's standardize. Let's discuss what is a so-called responsible investing. And based on that, also how we measure it. Because ultimately, we want to develop something which is translatable for users. And we have managed it for other things. Just think about, we have accounting standards. We have standards how to express return. Why we don't have standards to express improvement on the SDGs or on ESG factors. That's doable. It's just teaming up.
Yeah. Angela, I think you wanted to come in there as well.
Oh, I just wanted to comment on Amit, just about being positive and investing in things that are giving a positive impact. And even though we can't or have challenges with measuring this, like we measure the performance from the diverse managers. But what we want to see is those diverse managers actually invest in diverse companies and diverse neighborhoods. And that's something we haven't been able to measure, and something we want to get our arms around, the impact of actually investing with diverse managers. We see it in our portfolio returns, but we want to see it outside of there. And a lot of times managers are actually doing positive things around ESG and don't realize that they're doing it. So how can they measure it? Because it's not even triggering to them that this is something positive. They're just doing what is good business. And those things go together. So we have to, we meet with our managers and, we're like, that is really good for the environment. And it clicks, like they've never even thought of this, and so I'm like, you have to actually recognize and acknowledge what you're doing, not just for business sake, but for the impact sake, and then start to measure it. And I think around diversity, you got to start with policies first to really systematically embed it in your organizations. And then, go from having a policy to having goals, to measuring them, and then to challenging yourself to stretch those goals.
Jean-Jacques, do you think what Guido describes there is achievable, and in what sort of framework, what sort of time frame do you think we're talking about where we get to the point where there is an agreed set of standards that everybody sticks to?
I think to come back to Guido's point now, I think we would live in a much easier world in a way if on the climate side, for instance, we had, of course, a worldwide carbon price. Unfortunately, this is not the world we're living in. So that's one side of the equation. The other side of the equation, something I don't like in our industry, that in debates that I hear from time to time, is we have I would say a slight tendency to hide behind ourselves behind the data question. On ESG side, I don't think we're missing data. I think we have too many data. Actually, we have way too much data. The problem is indeed the quality of the data we have and the fact that they are not harmonized. I know if you've seen, but I think it was a month ago, OECD released a very nice report showing very well that depending on the data you use, data that is accessible on the market, basically the outcome you can have in the measurement of the carbon intensity of your portfolio can be very different. It is slightly challenging. But at the same time, I fully agree with Guido. There is no way that we can hope to have a full harmonization at worldwide level in the very short term. And if we wait for that, basically we're completely missing the challenge because we need to do things and act right now. So I think the best way to maybe it's not the best, but I think it's the practical way to manage the situation is clearly probably to forge alliances. And I would say on data sets or concepts that we can consider are the most neutral possible. So to give you a very concrete example, something we do at Amundi, we're quite huge supporters of the Science-Based Target Initiative because we consider that if we want to develop more and more portfolios that are Paris aligned, that are 1.5 degrees Celsius compliance. To do that, we need companies that are on the same temperature track. At the moment, at worldwide level, you have something like 200. If I build all the portfolios of the 1.5 trillion we manage out of these 200 companies, I don't think my clients were going to be extremely happy in terms of diversification. So what we need is to have more and more companies that are engaged and committed with a science-based target that is aligned with the Paris Agreement. And coalition behind that to push for that through our investment, through the way we engage companies, I think is a practical way forward in the short term. Otherwise, if we wait until there is a European taxonomy aligned with the Chinese one, and I hope at some point in time a US one, of course this is desirable, but the problem is that we need to do things not in 10 years to come, but actually in the 10 years to come.
I wonder, one of the kind of ways, I guess, that the investment industry as a whole could really help to address the inequality issue is that still financial services are the preserve of relatively wealthy people. How do we tackle inequality by opening up access to returns to people with lower incomes and lower opportunities. Is that something that Amundi, for example, can address?
I don't know if we can address it all by our own. I think where we could be positioned to do that is the fact that we are the asset manager of a number of retail networks at European level. So we have, I would say, that direct access towards something like 100 million clients directly, which is important. And I think here it depends, of course, on the countries. I think the point you're raising is also very important, because for me, the next frontier of this type of questions and ESG debate at large is really the retail part of the equation, and really the individual and investor. I think nobody can be as sophisticated in its own personal investments, particularly for the people that do not have massive amounts of money to invest as institutional investors. And so you need, to come back to your question, also to make this type of impact investment accessible for the individual retail end client. And for that, I think what you need the most in that environment is simplicity. Not being simplistic, but simplicity. Basically, the man or the woman in the street, no offense, has no clue of what ESG is. And has no clue of the practical implications it may have on the way he invests into a life insurance contract of a few thousand euros. And I think to make accessible this type of concepts through to retail participants is key. To give a practical example, something we start to deploy at Amundi, also in the networks we're working for, on the climate side, for instance, is to have measurement of the temperature of the funds that we're offering to the clients. So in a way, this can be, by the way, you have methodological questions, but I think this is a way to make the whole question accessible through your investment to someone that in a euro life denominated contract is going to invest a few thousand euros a year.
I mean, Amit, do you think this is something that the industry is starting to look at, is its own accessibility and its own standards?
Yeah, I think it's such an important issue, and there's such a big gap between supply and demand. And what I mean by that is, there's surveys all around the world that not just younger folks, but working people want their money invested in a way that creates a better future for themselves and for their families. And so, it's a fundamental question of, what world are you investing in? And people, we see the data on climate change and inequality and how prominent these social issues are for people. And I think it'd be very powerful to connect their money to those kind of values and aspirations for the world. But we have seen very limited access, whether it's ESG funds or impact investment funds, to broader retail. I do think it is, in part, it's, there's obviously, distribution platforms that sit between a retail investor and all the funds that people are developing. But I think that is one of the big opportunities that we really need to unlock if we are going to achieve the Paris Climate Accords and the SDGs, that we have to create pathways for people to put their money to work, to contribute to these bigger global goals.
Yeah.
I can say that the work that Angela does and other people are leading, like pension fund assets, is so critical, because obviously they are investing on behalf of working people. And so those are some platforms that I think are absolutely critical to driving, though indirectly, this retail access where people's personal assets can be invested in a way that is aligned with creating a more inclusive and sustainable world.
And Angela, on that point, do you stress this to all of your stakeholders? Do you tell them, look, this is what's happening with your money, or do you feel like the returns just speak for themselves and they don't need to worry about that?
Actually, our stakeholders stress it to us. They are, it's 88,000 teachers, and they are a diverse group of teachers, and they want to see their money invested with people that are reflective of them. So the goals are really coming from the stakeholders to us, and we're implementing what they want. And I think we're trying to take it a step further by not only doing that, but we challenge our managers to hire diverse candidates, because we feel that this is the pipeline that these managers will come from. So you hire diverse candidates, and eventually that is where they get their track record, their experience, you know, the ability to source deals, the ability to exit funds. So, and those are the pipeline of people that are going to spin out and be those diverse managers. So we're trying to work with our majority-owned managers and get them to see, you know, this is not only, you know, something that we're working on, but you are working for us and we need you to do this as well. And we try to work also through our proxy voting rights, which our managers vote for us. But we have a proxy voting policy that stresses, you know, the themes that are important to our trustees and to our members. So it's we're all kind of working together and trying to figure out a way to, you know, have managers not only do this for us, but make it a part of their organizations and do it for other clients.
It's a fascinating point. And as you say, the demand is there from your stakeholders. So you have this virtuous circle. It kind of goes back to what Jean-Jacques was saying at the beginning about the inflows. You know, once the demand is there, the rest of it kind of works itself out. I want to address some of the questions that people have been asking. There's an interesting question here. Is it almost a problem that we bundle E, S, and G together? Because on the face of it, they're such wildly different targets and different strategies. Would it be better almost to kind of chop it up? I mean, Guido, what do you think? I mean, I know that they all interconnect, but does it make life more difficult that we bundle them together?
Ultimately, you need to analyze each factor on its own. So if you look at the company, of course, it goes through whatever the 300 criteria. Some are covering the social, other pieces, environment and governance. That's why you do the bottom up, and ultimately you give a score to a company, which is the combination of. And I feel, but with an ESG, you make it simpler with an ESG rating for an overall assessment of a company. And personally, for me, divestment is the worst case. Because then you can't finance an important transition. In order to give a company a chance to make that transition, the company needs funding, and that's why. What if you just look at a company which socially may be super low, but very strong in governance and very high on climate? I think maybe it's worthwhile, but you need to speak up as an investor. That's why investing is one piece, but also you need to engage. And for example, we co-founded the Asset Owner Alliance for Net Zero. And this is powerful because it's not just one company you line up with others, but you look at the full scale of impact investing. And I personally feel if you kind of take it completely separate, again, you have consequences which probably you don't want to have and not really ideal to reach. I strongly believe. Yes, bottom-up assessment of all three letters separately, but ultimately both and all three are long-term trends. And for that, you need also a long-term vision. And always feel pension fund money like Angela is managing, but also insurance money. This is the right source for funding this transition for the real economy.
Yeah.
And
rather than just handing over the assets to people who don't care.
Plus, on top of things, it's also if you think about insurance, insurance is also it's risk sharing. You protect the weaker parts or the unfortunate through a pooling, and then you do the smart thing with the pooled money. Similar thing with pension fund, again, has all the protection scheme. That's why the fundamental piece of both actually fits perfectly with that long-term investment strategy, which it looks at all three dimensions.
You know, we could talk all afternoon, but we're not allowed to. The counting clock on my screen is counting down very aggressively at me at the moment. It's been a really fascinating discussion. Thank you so much for sharing your thoughts. Jean-Jacques, Guido, Angela, and Amit, thank you so much. It's been a really interesting conversation.
Thank you so much.
Thank you.
Thank you very much.
Thank you.
Well, thank thank you very much to Katie and indeed all our panelists there. As an investor and the FT's former personal finance editor, I have to say, I think ESG is the topic of the moment for readers and for investors. And certainly it's one that's really come to fore during the pandemic, because everyone's been thinking about ESG, whereas a couple of years ago, it was a bit of a niche of the investment world. But now retail investors like me, big institutional investors like Katie's panel, are firmly focused upon it. And one of the reasons is performance. I mean, we've seen a fantastic performance from ESG-friendly investments during this pandemic, and that has really turned on a lot of investors to the idea of greening up their own portfolio. And one thing I will take away from that panel is just how the spread of what ESG is interested in reforming is changing. It's not just environmental, it's diversity, as we heard from Angela. You know, diversity within the fund management industry itself is now quite rightly coming under scrutiny. But then also the issue of tax and how much tax companies pay. Now, in the past, investors might have thought, well, you know, we want the companies that we invest in to be taxed as lightly as possible because we want the most of their returns to come back to us in the form of dividends. But of course, now with all the debates over digital companies, that is again something that the global boardroom is turning to discuss. You heard it here first. So don't go away, because next up we have our Moral Money live panel, putting employees at the core of business. See you shortly.
FT Next Gen is going to be tackling these issues that are affecting young people the most and preparing you for this new future.
30-minute body weight workout session. You ready?
COVID and locking up millions of households has created as a once-in-a-lifetime reassessment of what a home is worth to people.
The pressures that were there at the beginning of lockdown, it's still very much present.
It's not about age, it's about determination and action.
So when I think about anti-racism, it's not something that you can be. It's a constant state of practice.
I read a book on burnout like early in the year when I did burn out. That is something that I recognise and I see in a lot of my peers. That is a big worry, I think.
When do you switch off? What's too much? Being online is not the problem. It's how long you spend online.
People are really coming to dating apps because it's the only game in town right now.
If you are going to risk going out to meet somebody else, you have to be worth it. There's no it's not just, I'm bored and we're going to do it. It's that you have to be worth it.
If you have uncontrolled transmission of the virus, the health service is strained because there's limited beds and limited health staff. If many of those staff are off because they have COVID or they're recovering from COVID or have long COVID, we don't have enough people to treat any of those things.
I think people like to delineate it in between collecting for and collecting for investment. Often there can be a conversion to security. I always think that your gut is right.
The message matters, so the tailoring of it, and the messenger matters.
We have to really provide the information that can make people feel like they're part of the solution.
It's just not about fabrics, it's about human sustainability, mental health, the cultural, everything.
Very good. And that's that for our Matcha Love Smoothie.
And that's our Bombay Bramble Clover Club. Cheers.
I hope you enjoyed today. Good evening and good night.
Well, continuing on the theme of building back better, we present another global boardroom session hosted by Moral Money. That's the FT's hub for all things ESG, with a very popular newsletter which focuses on how business and finance can become more socially and environmentally conscious. Now, this panel is going to discuss how companies can profit from putting employees at the centre of their strategies for growth, a particularly important topic given the impact of the pandemic on companies and jobs. Now, our US business editor, Andrew Edgecliffe-Johnson, is moderating this one, and he is joined by yet another expert panel of guests. We have with Andrew, Rebecca Henderson, who is professor at Harvard and author of Reimagining Capitalism. We have Rod Little, who is the CEO of consumer healthcare brand Edgewell Personal Care. And we have Bruce Simpson of our knowledge partner, McKinsey & Company. But before we get going with this session, Andrew and Rebecca are going to frame the discussion, and they have invited a very special guest to join them. Stay tuned.
Our research says that more than 70% of all transformations fail, but leaders can learn from the 30% of transformations that are successful.
You have to have a compelling story that your employees and your customers will embark upon the journey with you and believe in your vision. Short-term wins are really critical.
Transformation isn't a one-time event. It's about creating a culture where common sense becomes the common practice. When you multiply that across the company, you get real change.
Welcome to the FT Global Boardroom. There has been no bigger story in business lately than the debate about quite what purpose companies are supposed to be serving in the 21st century. So I'm delighted that we have with us to discuss it today two thinkers on opposite sides of the argument. Professor Rebecca Henderson of Harvard Business School. Rebecca, hello.
Andrew, thank you. It's a pleasure to be here.
Thank you very much for joining us. And I hope we also have the late, great Chicago economist, Milton Friedman. Professor Friedman, Milton, if I may, can you hear us okay back there in 1987?
Would you come to your question?
Could you just check your cameras on, Milton? It should be the button on the bottom of your screen.
Sure. I am Milton Friedman.
Great. Thank you. That seems to work. So I should probably explain what's going on here. We tend to assume that business is driven purely by numbers, share prices, bond yields, interest rates, and inflation figures. But business markets are also driven by ideas and narratives. And sometimes a narrative comes along that's so powerful that it sets the agenda for companies around the world, affecting millions of employees, billions of consumers, and the planet itself. And for the past 5 decades, there's been no more influential idea in business than the one that Milton Friedman set out in 1970, when he wrote that the only social responsibility of business is to increase its profits. But lately, that notion has been challenged by a whole new school of thought, what's called stakeholder capitalism, the idea that companies should be paying as much attention to their employees, customers, suppliers, and the planet as to their shareholders, has been embraced by some of the world's top investors and executives. So, Milton, you are sadly no longer with us to stand up for shareholder primacy, but I have had so many questions about what you'd make of this moment. So I'm very glad that this new time machine feature on our video conferencing software will let us hear from you.
I will be glad to answer those questions.
Wonderful. Your video is still a bit glitchy, but let's carry on, hope for the best. Rebecca, you teach one of Harvard Business School's most popular elective courses, Reimagining Capitalism. Don't you agree that business has a duty to increase profits for its owners?
Managers have a legal duty to show care, candor, and loyalty to their investors. But they only have a moral duty to maximize profits when markets are genuinely free, really competitive, prices reflect real costs, and externalities are properly priced. When that's not the case, to focus on nothing but profit maximization is, I believe, to betray the fundamental moral commitments of capitalism, the commitments to freedom and prosperity that Professor Friedman is so concerned about. In our current moment, for example, a single-minded focus on profit maximization would seem to require that firms throw carbon dioxide out of the window, dump waste into the river, drive wages as low as they possibly can, fish out the oceans, and attempt to rig the political process in their own favor. If firms can do all that, focusing on profit maximization seems unlikely to increase either social welfare or general prosperity or individual freedom.
Milton, what do you make of that?
I think that's a gross misconception.
Why do you say that?
The way to get efficiency is to make people face up to competition, to make them shape up or get out. That's the American system of competition. It's a system that produced our great progress.
But Milton, in the last 50 years, the world has changed almost beyond recognition. It looks less and less like the textbook model of free and fair markets that were more or less in place when you suggested we should just focus on profits at any cost. In today's world, the single-minded pursuit of shareholder value is not only destroying our societies and possibly the planet, but also putting the very legitimacy and strength of capitalism at risk.
Milton, you've obviously not been around to see this, but I should say there was a real dive in public confidence in capitalism after the financial crisis of 2008, 2009. But since then, actually, this stakeholder capitalism mantra has taken hold. We've seen companies regain some of that lost confidence by stepping up to increase wages, offering more paid sick leave during a pandemic, eradicating slave labor from their supply chains and cutting their carbon footprints. Isn't that just the good and even moral thing for a business to do?
How can you do good with somebody else's money unless you first take it away from them? You know, there's an old saying about the road to hell being paved with good intentions.
Can you just check your camera button again, Milton? Thanks.
Now we come to your question of basic morals. How did our moral system develop? Well, for some people, it was laid down on the Mount through a sermon. For other people, it was in the 10 tablets brought by Moses from the Mount Sinai. For still other people, it's in the writings of Muhammad. Many places where people get morals. But in the end, the common values that people share derive out of a market.
Rebecca, Milton's got a point here, hasn't he? Capitalism's about capital. It's about transactions in free markets. You know, are markets and the providers of capital really going to allow companies to lose that simple, single-minded focus on profits?
Definitely. From a moral perspective, taking capitalism's commitments to freedom and prosperity seriously not only permits, but also requires that managers take responsibility for the health of the institutions in which they're embedded. But it's also increasingly clear that it's just good business.
Milton, do you want to jump in here?
As Abraham Lincoln said, you can